New York City, I'm Shauna Smith alongside Madison.
This morning as the rotation out of mega cap stocks continues, cemented as chip stocks are falling off of possible trade restrictions. So let's get to it with the three things you need to know this Wednesday morning. Yahoo Finance's Jared Blickery, Rick Newman, and Josh Schaefer have more.
Stock futures falling as shares of chip stocks from Nvidia to ASML decline. The possibility of tighter trade restrictions from the U.S. and comments from former President Trump fueling the moves lower. The Biden administration reportedly considering a stricter crackdown on competition from China in the chip space, which involves controls on foreign-made products that use any American technology. Meanwhile, in an interview with Bloomberg Businessweek, former President Trump claimed Taiwan took 100% of America's chip business and that Taiwan should pay for the U.S. for defense. Taiwan Semiconductor shares falling in response. The comments heightening political tensions, casting doubts over U.S. commitment to protect Taiwan if Trump gets a second term.
In that same interview with Bloomberg Businessweek, former President Donald Trump saying that if he wins the 2024 election, he will let Fed Chair Jerome Powell finish out his term, especially if he thought Powell was, quote, doing the right thing. Powell took office in 2018 and was reappointed for another four-year term in 2022. That puts Powell at the top of the Fed until midway through 2026. Trump told Fox News back in February that he wouldn't reappoint Powell, saying he missed on inflation. In the Bloomberg interview, Trump also said he'd consider J.P. Morgan Chase CEO Jamie Dimon for Treasury Secretary.
And investors are feeling bullish as the Fed mulls rate cuts and Wall Street prices in a soft landing. That's according to Bank of America's Global Fund Managers Survey. Investors also discussing the 2024 election, with the majority saying either a Democratic or Republican sweep would result in higher bond yields and a higher U.S. dollar. Just under 50% say a sweep in results would be a boost for U.S. stocks.
Let's take a look at futures here, because if you see, a lot of the major indices are under pressure this morning, really as that rotation that we've been talking about starts to cement. You can see the Dow here moving to the downside, similarly with the Nasdaq and the S&P, both down over 1%, the Nasdaq down 1.5%. And this comes as we are seeing a lot of strength in the Russell as that rotation to small caps does start to continue, particularly as the chip sector, which has really given a lot of oomph to the melt up that we've seen in the market over the past couple of years, is starting to buckle as well.
Yeah, certainly. I think a lot of the focus here this morning, Maddie, is on the chip giants and exactly what we are seeing there. So this is a 5-day look at the Nasdaq 100, but let's take a look at what we are seeing this morning in extended trading, because again, it's a bit of a different picture. We are seeing right across the screen is this smaller number that you're seeing up here, and a lot of this has to do with reports about trade restrictions, or ramped up trade restrictions that could be coming, and essentially what that means here for larger chip giants. And we're seeing that weighing on the broader tech sector at large. So again, this rotation that we have started to see over the last several days that you were just talking about, this broadening out beyond that mega cap tech and into some of the smaller cap names, that has certainly been a trade that we have closely been watching. When you take a look at the Russell 2000, some of the outperformance that we have seen there over the last couple of trading days, but really over the last 4 trading days. And I bring that up because we have seen this gain of about 10%. It's actually outperformed the Nasdaq 100 by 12 percentage points, and that's the biggest gap that we have seen, the largest outperformance since going all the way back to 2011. So lots of questions about whether or not this rotation, whether or not this trade that we have seen, some of that momentum is going to stick. Obviously, only time will tell, but we have seen investors very optimistic about what a potential rate cut is going to mean for some of those smaller cap names that have been underperforming now for so long.
Yeah, and whether that rotation is going to be a painful one has been a big question for a while. Right now, it's not a painful one if you are in the Russell 2000 at least.
All right, let's turn now to a top trending ticker here on Yahoo Finance. A top story that we're watching, that's ASML. Shares of the chip supplier are falling. You're looking at losses of nearly 8% in extended trading on the move lower on reports of tighter export restrictions are overshadowing a surge in bookings. The company also out with earnings results before the bell. Now, ASML is not the only chip maker in the red today. Reports of those tighter export curbs pushing China chip giants, including Nvidia, AMD, and Taiwan Semiconductor lower here this morning. So here with more, we want to bring in Jos Versteeg. He is Insinger Gillison's a senior analyst. Jos, us. It's great to talk to you again. So let's just take a step back, because when you take a look at these earnings results that we got from ASML, clearly a lot to be excited about just in terms of demand and the numbers that they put up the most recent quarter. But the geopolitical risk is overshadowing that. I'm curious what the implications of these reports, what that ultimately means here for ASML.
Well, actually, I don't think that the implications are so bad for ASML. When you look at China semiconductor manufacturing, they're producing mainly low-end chips. And the US wants them to keep on producing low-end chips because the world needs it. And they want to stop them or not be able to make high-end chips because they can use it for artificial intelligence. And some years ago, there was a very interesting report from the National Security led by Eric Schmidt. And it was said that the US should prevent China from becoming better and better in AI, because who is the best in AI will win the next war. So it's quite serious for the US to stop China developing artificial intelligence, and so to deprive them from the high-end chips. But they're not producing it so much yet. So I don't think the implications are very, very strong for ASML.
The market strongly disagrees with you, it would seem, this morning. What do you think the disconnect is?
Well, the ASML was up, 30-40% this year. When you invest in these kind of tech companies, you can get a very, very, very nice performance. But now and then there's a rainy day, and that's the way I see it. So just from the beginning of the year, you're still in a big profit. So I actually don't worry about it. And I'm used to it. Sometimes it's bad, sometimes, most of the time is good, but there are some rainy days there. So I'm absolutely not worried there.
So I'm curious how you think ASML balances the threat here of further export controls from U.S., and then also just balancing that with the need, just in terms of the fact that it's so critical to their business to sell gear here to China. How do they balance that? What, I guess, do you think those discussions are like right now?
Well, yeah, that's difficult to say because they don't want to say anything about the geopolitical things. But when you look at the revenue, 50% of the revenue in the second quarter came from China. But that was heavily distorted by the fact that there were very few expensive machines sold to Taiwan. So it was distorted. When you look at the order portfolio, China is way more smaller. Maybe it's 10% or something. So that's also a very important part of ASML. Another thing is they still sell machines like the NXT 1980. That's a machine with a value of about 60-70 million, and that is still allowed. And I think the US will keep on, will make it possible for ASML to still keep selling that machine because it's important for more lower middle end chips. So there's still a lot of market for ASML in China, but only not in the high end. And you know, half of the factories in China, they are foreign companies. So when they don't get the machines anymore, they go back to their own country, to Taiwan or India or Vietnam or America. And the other half is just Chinese companies. And they keep on producing these mature nodes, these low-end chips, because we need them for the car manufacturers, for all kinds of electronics. So the effect is, it's a pity that they can't sell these machines anymore to China, because it was in the future, it could be a nice, interesting market, but the market is so big. When you look, we see big developments like electronification, artificial intelligence, the energy transition. There's a big market there. When the whole semiconductor market will double in the coming years to 1 billion a year. So there's a lot of growth there, and ASML has a perfect position there. I'm absolutely not worried, and it's just the normal volatility you get once in a while.
Really quickly, I want to talk to you about this interview that former President Trump gave to Bloomberg Business Week. And in it, he talked about cooling the relationship with Taiwan and the protectionism the U.S. has over Taiwan. What impact could that have on chips, particularly as we do see tensions ratcheting up in the South China Sea?
Yes, it's not smart to say that, but I think it's positive for ASML because there are more and more companies or more and more countries who want to have their own semiconductor production. So it will be more widespread, not only focused in Taiwan, but also we see that there are 3 fabs from TSMC in Arizona in the US, but there will be more pressure to build more factories outside of Taiwan. So there will be, in the long run, there will be a little bit maybe overcapacity. But in the short run, it's absolutely not bad for ASML.
Jos, really interesting points. Thank you so much for joining us this morning. That was Jos Versteg, Insinger Gillison, Senior Analyst, talking about ASML. Now, as I just mentioned, former President Trump saying he would, saying a lot of things in this Bloomberg Business Week interview, but speaking specifically about Federal Reserve Chair Jerome Powell, saying that he would allow Powell to serve his full term if Trump ends up back in the White House. In that interview, also saying that he would let Powell serve the term, especially if he was doing the, quote, right thing. The former president also making some suggestions for U.S. Treasury Secretary in that interview. Yahoo Finance's Rick Newman is joining us with more of these takeaways. Rick, always great to speak with you. So interesting to get his commentary on Powell, but also, as the Bloomberg reporters noted throughout the piece, this is a former president who is prone to making promises that are not kept. To what degree do you think that he will follow through with keeping Powell, given that in that interview he also talked about wanting lower rates and lower taxes more long term?
Right. So what he said about Powell is if he would keep Powell in place through the end of his term in 2026, if Powell, quote, does the right thing, what that means to Trump is Powell needs to be lowering interest rates. And as we've been discussing for months now, guys, I mean, it is quite plausible that the Fed will be lowering interest rates just by coincidence, really, because it is all the data that's been coming in for recent months suggests that inflation is getting solved. Inflation is coming down. A lot of what the Fed wants to see happening is happening. And of course, there's almost 100% likelihood, according to markets pricing this in, of a Fed rate cut in September and possibly more Fed rate cuts after that. So that could actually provide the cover for Trump to say, OK, fine, I'll let the guy finish his term, even though I don't like the fact that he allowed inflation to happen in the first place. The rest of this Bloomberg interview suggests to me that Trump has heard the concerns that Wall Street economists and a lot of others have been talking about with regard to Trump, that his tariff policies would actually make inflation worse, not better, that he talks about lowering taxes at a time when we're starting to have genuine concerns about the size of the U.S. national debt. So he's basically saying, yeah, I get it. I hear what everybody's saying. Trust me, we're going to have low taxes and low interest rates. But in this interview, he's not connecting the dots. And it's going to be a lot harder for Trump to get away with doing these favored policies, cutting taxes without consequences in a second term, just because the macroeconomic environment is completely different than it was then. There's a lot more we could talk about, but we've still got 4 months till the election.
We got 4 months until the elections. Let's talk about the other side of this race, President Biden here. Now, there are reports out saying that we talked long about the growing divide that we're starting to see play out within the Democratic Party. But now, over the last couple of days, there are reports that some Democrats are pushing the DNC to delay a virtual roll call on President Biden's nomination. This could potentially take place initially, at least, as early as this weekend. What are you hearing there? And I guess how do you see this all playing out?
Well, staying out of the weeds of internal Democratic Party processes, what's going on here is the Biden campaign basically wants to lock in Biden as the nominee, which is not formalized yet, a couple of weeks before the convention, which starts on August 19th. And this battle to get Biden to withdraw is not over inside the Democratic Party. Biden seems to have stabilized his campaign a little bit after that terrible debate performance on June 27. But there are still massive concerns inside the party about Biden's inability to beat Trump simply because he looks so old and frail. So this little battle, it's not a little battle, it's a big battle inside the Democratic Party, is going to continue. And basically the deadline here is we've got about 3 weeks for Democrats to decide if Biden is going to be their nominee or if they're going to try to get somebody else. So it is not going to be the sleepy days of summer for Democrats during the rest of July and the first half of August. This battle is going to intensify, and I can't tell you how it's going to come out.
Well, Rick, I'm going to ask you to give us one more take before you go, and that's on President Biden's commentary at the NAACP event the other night. I just want to play a quick soundbite from him and get your take on it.
The idea that corporate-owned housing is able to raise your rent $300-400 a month or something, under what I'm about to announce, they can't raise it more than $55.
So, Rick, that commentary came on Tuesday night in Las Vegas, and he obviously meant to say that 5% number versus saying that rents won't be able to be raised by more than $55. Yeah, go ahead.
We're going to continue to see this from Biden. Look, I mean, this guy has been known for gaffes and flubs his entire career. And when he was younger, it was easy, to kind of laugh it off and say, well, that's Joe Biden being Joe Biden. In clips like that, he looks like he's not comprehending what he's reading off the teleprompter. And this is why, so the Biden campaign tried to paint that terrible June 27 debate as a single bad night. Biden himself used that phrase. And I think it's apparent that it's not a single bad night. It's an ongoing situation. I will say for everybody, Joe Biden is not senile, and that's ridiculous because he is capable of articulating very complex ideas. He did it on foreign policy, for example, during one of his recent interviews. But he's old. He has all the hallmarks of somebody who's old and is not in complete command of everything that comes out of his mouth. And the Biden campaign just needs to acknowledge that and then tell us, yeah, we expect Americans to re-elect a geriatric candidate despite everything they see with their own eyes.
I don't know. I'm still in my 30s, and I struggle plenty on my own with the teleprompter. So I feel for him a little bit. All right, Rick, thanks so much.
Bye, guys.
The S&P 500 closing at another record high on Tuesday as investors continue to bet on rate cut optimism. But geopolitics could pose a risk to that narrative. That's according to a Bank of America's latest global fund manager survey. Yahoo Finance's Josh Schaefer joins us now with some of the key takeaways from this report. Let's start there, just in terms of the biggest tail risk and some of the shifts that we're seeing.
Yeah, sometimes I think when I see geopolitical risks listed as the top risk, you could almost view it as a contrarian. Okay, maybe there aren't a lot of risks that are actually immediate to the market that are coming up at the top of investors' minds, right? So when you look at the actual chart here, I think the bigger takeaway is probably that you see higher inflation coming down. So yellow is May, what respondents said in May, light blue is June, and then purple is July. You can see inflation slowly receding there. And then at some point, respondents have to pick something, right? They're not going to pick no risk. And so I think maybe the broader takeaway here, when you consider also what the rest of the survey tells us, and I know we're going to get into soft landing in a second here, but if investors are seeing high inflation as not as big of a risk, I think a lot of people would argue for markets as far as what could immediately impact markets. That's probably the biggest takeaway. Geopolitics are always an issue. And perhaps the bigger issue within geopolitics is it's something that we're not thinking about. So it's something that maybe we shouldn't spend too much time on. But inflation is a big one, and I think that was one of the bigger takeaways here is investors are feeling better about a soft landing. That chart that we've been following for months now, we saw no landing come up at one point. Hard landing has come into favor a little bit more at times. But investors feeling the best they've felt about a soft landing since the start of 2024 feels like kind of the market moment right now with the action we've seen recently.
Yeah, it's interesting. We just had a guest on essentially teasing this idea that even if we had a Chinese invasion of Taiwan, that could be good for some chip stocks. So, I mean, the geopolitical question mark in the room is certainly a tough one for investors to parse. But I want to zero in on the soft landing point that you just made. It just feels like you can't be that mad at the Fed about anything if they are able to engineer this soft landing. And taking a look at that first chart that we had from you about investor sentiment surrounding higher inflation, the degree to which those concerns have fallen off from the initial report from May. If I'm Jay Powell, I'm looking at that and feeling pretty good.
And the kicker here is the survey was done from July 5th to July 11th. So the last day someone could have responded was the day of the good June CPI prints. It's probably fair to assume a lot of the responses here didn't even include that good print, right? That sort of sent markets soaring over the last couple of days. But this trade is clearly, it's the Russell 2000 trade we've been talking about a lot over the last couple of days, right? Small caps outperforming the S&P 500. by their biggest amount we've ever seen in 5 days. Like, the soft landing trade is the trade right now. So it certainly adds up that that's how investors are feeling. It'll be interesting to see in a month from now when we get the August print. Does that number go up even more, or are people going to be sort of wishy-washy on the different little data points we get between now and then? I'm curious if we can stay this euphoric, Maddie, for this long.
Yeah, that's the big question.
All right, Josh, thanks for joining. We are just getting started here on Morning Brief. Spirit Airlines taking a hit after slashing its second quarter outlook. We're going to dive into some of today's top trending tickers. Oil prices moving higher today on the back of a 3-day losing streak. We will speak with a guest later on in the hour about 2 catalysts that could actually drive crude even higher. Plus, Johnson & Johnson cutting its full-year forecast as it juggles M&A costs. Stay tuned for our 10 a.m. hour of Catalyst. Our very own Anjali Kamlani will be speaking with Johnson & Johnson CFO Joe Wolk. All this and more. You're watching Yahoo Finance.
Let's get to some trending tickers here. Johnson & Johnson out with second quarter results this morning, slashing its full-year profit forecast as it faces higher costs from recent acquisitions. Yahoo Finance's Anjali Kamlani has the breakdown for us. Hey, Anj.
Hey, Maddie. Yeah, so Johnson & Johnson a little bit under pressure today because of its acquisition of Shockwave that impacts its medtech portfolio. You see that stock just a little bit down, a little bit they've managed to pare some of those losses after the earnings call this morning, but we'll see what happens when the market actually opens. The discussion on the call, I was just listening to it, really focuses on what the plan is for medtech. We've seen that portion of the business really be sort of flat over the years, and they're promising some acceleration in business despite the impacts of inflation on that area. So looking at the numbers broadly, we know that pharma brought in $14.5 billion for the quarter, medtech $8 billion, slightly higher than the previous quarter. There's also the COVID sales, which have not been included and will not be included moving forward. This is the last quarter that they had any sort of COVID sales, driving up 7.2% sales worldwide. And so what the story is for Johnson & Johnson this morning is that it's in a bit of flux, if you will. Not something we are used to seeing. It's a pretty solid contender most times, and it is the bellwether for the industry. We also have seen that in the discussions this morning, the Stelara, that's the one that is in discussions with the IRA for the Medicare pricing, is also going to be facing biosimilar competition. And so the company expects impacts from that as well towards the end of the year because of the biosimilars in Europe being introduced. So all of that put together, putting a little bit of pressure on the stock this morning. But we'll get to all of that and more with CFO Joe Wolk this morning. So stay tuned.
We're looking forward to that interview, Anja. It'll bring us here next hour. Let's also talk about another headline that's grabbing attention within your coverage space, and that's some positive data that we're getting out from Roche for its weight loss drug. What can you tell us there?
That is the second weight loss drug it has good news about, and that is from its acquisition of Carmot Therapeutics. And that is something that is driving down or putting a little bit of pressure on Eli Lilly, Novo Nordisk, because this is an oral pill. So that is really, that competitive part of the market we've talked about in the past that could really sway the market and these two leaders. So it's early stage results. I have to emphasize that part. We did see 6.1% weight loss for those patients in the phase 1 trial. Whether or not that remains true or increases over time with the advanced trials will remain to be seen. But this is the second piece of good news in that category for Roche.
All right, Anj, thank you so much for joining us. We really appreciate it.
Let's talk about another trending ticker here on Yahoo Finance, and that is Spirit Airlines. Shares falling after lowering its second quarter outlook, saying that its non-ticket revenue per passenger came in, quote, several dollars lower than anticipated. So putting that just point blank, we are starting to see some weakness play out within the airline space, similar to maybe what we heard from Delta last week. They were the first major airline to report during this earnings season. Now, when it comes to Spirit, some of the weakness there, what we are seeing, the fact that they slashed their second quarter outlook really just points to weakness more broadly within the space. And we're seeing that reflected on your screen right now. You're looking at a number of airline stocks under pretty decent amount of pressure here on the heels of this result for exactly maybe what this would mean here for a larger part of the industry. But again, Spirit blaming its shortfall not on lower fares, something that has weighed on the entire industry this summer, but more so they're blaming it on a drop in revenue from add-ons. So it charges separately for such as assigned seats, printed boarding passes, in-flight, bottled water, that sort of thing. So that's what they are blaming some of this weakness for. But again, just looking at the market's reaction to this morning, it looks like Wall Street maybe is fearing something a bit bigger than just that there, Maddie.
Yeah, it's a critical kind of data point to watch, that non-ticket revenue, because this is a theme across a lot of major airlines, like you mentioned. And we kind of got a tease out of this in those Delta Airlines earnings as well. Not the degree, of course, of a revenue shortfall that we saw from Spirit today, but we know that for Delta, the pressure is coming from that very front of the cabin, right? Delta's getting a lot of their profits in from the business class, first class flights and tickets, and it is challenging when you start to not get those add-ons from those bigger spending ticket holders in the space. Just to run through a couple more numbers here, that new guidance showing unit revenue falling 12% versus the second quarter of last year, showing that industry capacity and is outpacing the overall leisure travel demand. So when you've got capacity on these airlines outpacing that demand, that is what's going to lead to some pressure for these stocks. And as we see the broader airline space starting to struggle a little bit, what does that tell us about the consumers who we've seen having this revenge spending post-COVID? Is that revenge spend starting to switch gears a little bit?
All right, let's talk about another top trending ticker here on Yahoo Finance day in and day out, and that is Tesla. This time getting a bullish call from Cathie Wood, the ARK Invest CEO, predicting to Bloomberg that autonomous taxi systems, robotaxi, could be, quote, an $8 trillion to $10 trillion global revenue opportunity, giving Tesla shares miles to run. Despite that, we are looking at some pressure on Tesla. You're looking at shares off just about 1%, but more specifically, and why she sees this being such a catalyst here for Tesla is because she is optimistic about Tesla's potential market share when it comes to this. She sees Tesla's ability here to take a 30 to 50% share of revenue generated from the fleet owners on his platform here. And she's saying that recurring revenue with explosive cash flows is going to help really boost the profit margins here north of 50%. So again, seeing it as a huge catalyst as we start the trading day here on Wall Street, Maddie.
I think it's fascinating the degree to which she's optimistic about robo-taxis, which the delivery of which has been delayed several times. Also saying autonomous taxi market winners are going to be a winner takes most opportunity in the space. I think it just points to some of the intrigue around Cathie Wood's calls. You're definitely a lover or a hater of those calls. One example of that, I just want to remind our audience of her call on Nvidia. ARK had purchased the chipmaker at $4 back in 2014, sold it off at a whopping $40 a share, which obviously was before the market rally that we saw with Nvidia here.
Okay, yeah, again, she's just saying that they're missing the size of the opportunity, how quickly it's going to scale, how profitable it's going to be. Well, we had the opening bell on Wall Street just about a minute ago. You're looking at pressure across the board, a bit of a pullback here from the record high that we saw yesterday. You've got the S&P off just about 1%. The Dow under some pressure. You've got the Nasdaq off the most here, the biggest decliner, at least here at the open as it calibrates, it off just over 1.5%. And Maddie, what's really driving the narrative on the street this morning, in conjunction with this rotation that we have seen into some of those smaller cap names, but also more specifically when you're looking at the losses for the Nasdaq, a number of tech stocks, really chip stocks, declining here on reports of the Biden administration's efforts here to potentially ramp up some of the curbs here for chips and exactly what that means maybe for the broader sector.
Yeah, a decline of over 1.5% is unusual at this point in time for the Nasdaq. But as a reminder, we're coming off of all-time highs that we hit yesterday and over 37 all-time highs for the year. So Steve Sosnick would be the first to remind us that we shouldn't be questioning those declines too much today.
All right, let's get over to Jared Blicker as a closer look at what is moving here at the open. Jared, lots of red on your screen there behind you.
Oh my goodness. Yeah, I'm watching commodities, but behind me is actually the chip space. This is our semiconductors heat map. Just wanted to focus on this for 2 seconds. A lot of dark red, but guess who's not in the red? Intel and Global Foundries. Intel up 6%. But as promised, let's get to the futures market because I have been tracking crude oil. Oil having a bit of a bullish move today. You can see it's up 1.62%, although pretty much in the trading range, in the middle of the trading range that it's had for the year. Latest news, we got the preliminary API report. It's a weekly report on oil inventories, reporting a 4.44 million barrel drop over the week. That will be confirmed or denied by the Department of Energy's numbers themselves by this that are presented later this morning at 10:30 a.m. Also seeing some incremental news on the developments in OPEC Plus. Iraq and some other nations, including Russia, have been cheating recently, but they have admitted to it and they've said that they're going to make amends in future months. And there's a lot of conversation about when OPEC Plus is going to ramp production back up, 2.5 million barrels. They're not going to have that conversation until December, the fourth quarter actually, but that's actually been moved up from the first quarter, so maybe a little bit sooner than we expected. Also want to focus on gold for 2 seconds while I got you. Gold is down well, it looks like, no, that's feeder cattle, but gold is actually up to a record high. If I can find the ticker here, there we go. It's up 0.4%. I'm going to put a 5-year chart so you can see the breakout here. 2,477 makes me think that 2,500 is in sight, guys.
We'll see. It's not too far from that level. All right, Jared, thanks so much. Well, stocks lower to kick off the start of trading. We've got much more on the morning brief and get you ready for today's trading day. We'll be right back. The chip sector under pressure this morning after former President Trump saying Taiwan should pay the U.S. for defense during an interview, but also really what's driving today's action is President Biden said to be considering cracking down on chip makers who ship to China. That's according to a report out from Bloomberg. To discuss what all this means here for the broader market, we want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to have you. So we have seen this rotation out of some of those larger cap tech names over the last couple of trading sessions, and then pairing that with this morning's news about reports of a broader crackdown here potentially from the Biden administration. I'm curious how you see that playing out in the market, potentially if we do see that go into place in the coming weeks.
Thanks for having me on. So, yeah, this is, in a way, this is not unexpected. I think everyone has been anticipating that as you see this continuation of US-China tensions, that unfortunately some of these chip makers' technology almost falls right into the spotlight. On top of that, of course, you've got very, very, very rich valuations for these companies. So inevitably, there's going to be some kind of consideration from investors about how this proceeds. Now, we continue to like those mega cap, the technology names, a lot of the software chip makers, but probably would not be adding exposure at this point and really looking across a broad portfolio to really think about diversification. Where else around the world will do well in that kind of trade tariff environment, and also which are the parts of the market which are less expensively valued.
Well, Seema, I feel like you're talking about some of the movement we've seen in small caps and that rotation that has really been cemented over the past week or so, particularly in the Russell. What is the catalyst for the movement that we are seeing in small caps right now? Is it the valuation picture? Is it the geopolitical tensions? Is it Trump's VP pick, who's typically been favorable to smaller businesses? What do you think?
So I think there's a couple of things at play. The valuation story, I think, has been around for a while. It's just we've been looking for that fundamental shift, which can prompt people to start increasing their exposure. Now, you know, you've had, as you said, you mentioned a couple of them. There's the Trump trade with this idea that actually, if you're more domestically focused, or if the U.S. economy is going to be benefiting, then it's the small cap companies which have a greater domestic revenue exposure than some of the large cap. But also it's about rate cuts. And we can see that it really coincided with that soft CPI inflation print last Thursday, when you did see that first very significant reversal. From here, though, I don't think it's entirely clear cut, because for small cap, not only do you have to have rate cuts, you have to have several of them because small cap have such a significant part of their debt as floating rate, but also you need to have a solid growth outlook. So on that basis, for this to continue, it needs to be that the Fed cuts rates in time to ward off a further economic deterioration. So I think it's still early days to see if this is going to be sustained or if it's just something which can go on for a month or two.
So, Seema, how are you positioned just given that uncertainty? Are you betting that this trade does have legs, or is it smart to maybe hedge this position at this point?
So we continue to have a greater exposure to the large cap companies. There's a number of reasons for that. I mean, I think we're going into a bit of an economic moderation. We don't think a recession is on the way, but that economic moderation probably means that you still want to have companies which are high quality, high liquidity. And also from a secular perspective, we still consider those companies as at the forefront of a lot of the productivity and growth advances over the coming future. So those are the areas that we're looking at, but we're also starting to think about where internationally, outside of the US, can fare well over the next 6 months to a year.
Well, let's talk about that, because I know in your notes you sent over to us as well, you talk a lot about global economic growth, and I do want to get your take on the potential risks to that within this election cycle. Former President Trump telling Bloomberg that we have a currency problem and talking about wanting to shift the 75% of non-farm payroll jobs that we have in services over to manufacturing roles, which would be a very big shift for our economy. If Trump is able to move the needle on that, and if his concerns about currency do get cemented into some sort of policy action, what could that mean for financial markets?
So it's a really good question. I think this is something that everyone is really focusing on at the moment. So if you were to see this increase in tariffs, concerns about, or actually let's look at the tariffs idea. Really, the US is the economy which really benefits the most. It's the rest of the world that would struggle on a relative basis. Within that scenario, we pickpoint India and Japan as the two countries which are a little bit outside of some of that spotlight. So we continue to actually like those economies. Latin America segments of it can do well. Europe is a little bit more in a slightly tougher position because not only is it very much exposed to some of those tariffs and the China economic weakness, but also within a geopolitical perspective with regards to spending on NATO, defense spending, I think there are some concerns there. For the US, though, if there were to be concerns about the currency, if there was maybe a push to have a weaker dollar, that's actually good news for emerging markets. So it's fairly balanced. I think China's probably the area that we would be the most cautious of in that scenario.
All right, Seema, thank you so much for joining us. We really appreciate it. That was Seema Shah, Principal Asset Management Chief Global Strategist. Coming up, we're going to continue to have all of your markets action ahead. Still looking at pressure across the major indices here. So stay tuned for more of that market action. You're watching Morning Brief. Crude oil moving to the upside here after a 3-day losing streak. Now that comes despite rising investor optimism on rate cuts coming in September and weak demand out of China weighing on the commodity. Here to discuss, we've got Claudio Galimberti, Rystad Energy SVP, Head of Global Oil Macro North America Research Director. Thank you so much for being here with us today. So explain to me what you think is the biggest factor that is moving oil markets right now, particularly after that 3-day losing streak. What do you think this relief is driven by?
Thank you very much for inviting me. I think that this is the week of China, specifically the Chinese. Their plenum is going to tell us the direction of China's economy for the next few weeks and months. And as usual, in the past, I would say 3-4 quarters, demand concern about China have resurfaced. So I think that this is the major factor for this week that everybody is looking at. I think that there are another couple of factors, the most important of which is in Canada. So fires in Canada are approaching a producing area, similar to what we saw last year. Last year, we had quite extensive outages in the months of May and June. And that is also currently affecting the prices. So probably the bounce back that we saw today could be probably ascribed more to Canada, the fact that the fires are raging, and also the expectation that in the United States we'll have probably another crude stock drop. We'll see in about an hour. But overall, I think that the markets are still tight, and we all see right now what's going to come out of Beijing, basically.
Yeah, so Claudio, so then what does that more, I guess, ultimately tell us about where the price is headed? Are we likely to stay range bound around these levels given the uncertainty and given kind of the dynamics that are at play? Or is there going to be one more of a driving factor, do you think, over the next several weeks?
Yes, I think that I would use the word range bound, specifically between 80 and 90. We have seen this range bound for the past couple of months, at least, apart from when immediately after the OPEC announcement 2 months ago, we dropped below $80 per barrel. There are a couple of reasons for that. The first is that I wouldn't bet Brent below 80 simply because OPEC has been very determined about defending this threshold, right? So they extended the cuts, the voluntary cuts, and they made a pretty stern announcement back at the beginning of June that they are going to extend, and the unwinding of the cuts, which is supposed to start in October, is going to be data dependent. So they only will do it if the market allows it. To the same token, I wouldn't bet too much above $90 per barrel. And the reason for that, we have seen more and more than when prices are high, there is an incentive for OPEC plus countries to not be compliant. So the month of April specifically, but also the month of May, we saw a huge, very, very huge undercompliance, but that was corrected. So in June, we actually saw almost perfect compliance from OPEC plus members. So I would say range bound is the name I would use, but I would also say that if there are geopolitical flares up, specifically coming from the Middle East or Ukraine and Russia, then higher than $90 per barrel we can definitely see for a few weeks.
Can you talk a little bit more about the impact of the Russia-Ukraine war on the price of oil and how you see that developing over the next 6 months?
Absolutely. So what we've seen, for the past few months, we have seen a rather stable production coming from Russia, about 10.4 million barrels per day, crude and condensate. So the great trade reshuffle that took place between 2022 and 2023 has now been well established. So structurally, Russia is exporting primarily crude to Asia and primarily products to Latin America. Then allows Russia to maintain a level of production which is not too far from what we had before the invasion of Ukraine. Now, what's important to remind ourselves is that Ukraine keeps on attacking via drones, refining assets well within the Russian territory. Now, while this has not caused a major disruption to refining operation, there is a potential risk. I mean, that can go on, and you can have outages that could go on for longer than a few days. So there is this underlying risk of Russia producing less because of the continuous attack from Ukraine. I would say that is one. The other one is, of course, the Houthi in the Red Sea. So we have seen very recently a flare-up of activity there as well, with a damaged vessel going through the Red Sea, and that is, of course, also another cause of concern that could reflect in prices in the oil markets. But of course, the biggest risk when it comes to the Middle East is the potential of a bigger conflict between Israel and Iran. So we had a beginning of a direct confrontation back in May. It didn't come through, and that's one of the reasons why the geopolitical risk came off. But it is a fact that the Hezbollah in the north of Israel and, of course, Hamas in the south of Israel are supported by Iran, and any flare-up in that region could cause Iran to be impacted. So the geopolitical risk is still there. We still need to basically deal with it.
It's a great reminder of the degree of the geopolitical risks globally, Claudio. Thank you so much for being here with us this morning. We appreciate it. That was Claudio Gallinberti, Rystad Energy SVP, Head of Global Oil Macro North America Research Director. Coming up here, Elon Musk saying that he's relocating 2 of his companies to Texas. We're going to discuss what you need to know about that right after the break. Elon Musk is relocating SpaceX and X Corp headquarters to Texas from California. In a post responding to a new California law barring school districts from notifying parents of a student's gender change, the entrepreneur is saying, quote, "This is the final straw. SpaceX will now move its headquarters from California to Texas. And in another post saying X Corp will be moving to Austin specifically." So here to discuss, we've got our very own Praz Subramanian. Praz, we were just talking a little bit about the likelihood of this being able to actually happen. What do we know?
Yeah, so, Musk has already moved the state of incorporation for SpaceX to Texas already. He's already done that. But moving the headquarters is a whole other thing. It's a much bigger deal. SpaceX has a rather large HQ in Hawthorne, California, which is right by LAX, which is home to the U.S. aerospace industry, right? You have a lot of defense contractors out there. Mm-hmm. Like I said, the massive SpaceX HQ is there. You can't just leave that. You can't just leave that whole kind of crucial area. Plus, Vandenberg Air Force Base is in Santa Barbara. That's where they launch a lot of their satellites from there, the rockets from there. Again, you want to be close to your space launching facilities, and this is a pretty big sort of value add there that they have based on the fact that they're so close to the Vandenberg Air Force Base. And look, the NASA Jet Propulsion Laboratories are. You have the whole industry there. That's where all the engineers are. That's where all the knowledge is. To leave and uproot everyone to Texas, I don't think it's very possible. You might move some officers to Texas, but I cannot see them in a short time moving everything to Texas from SpaceX headquarters.
Is this a move that you think could potentially backfire, just given the complexity of moving and from personnel to the equipment to their space there? Is this a move that could potentially maybe make it a bit harder for SpaceX to compete down the road? I don't know if I'm grasping at straws here.
No, I mean, it's you have a lot of people that are talent that live in that area, and they work at Lockheed Martin. They can work at any other. They can work at Boeing. They can work at any other company that's working in aerospace down there. Look at X, right? I think someone tweeted that you can say we're going to move to Texas. People don't have to leave. Yeah. If you're a software engineer at X, you can just move to another software company. So I think that's sort of the big problem is the talent. Are they going to want to leave the comfort in California to move to Texas and Boca Chica and places like that? I don't know. It's hard to say.
Can he just rebrand, though, one of the offices in Texas and just say, now this is the headquarters? That's like a one-day change.
You could do that, have your CEO have a seat there,
right.
and stay there and be like, this is our headquarters, but we still have operations in California. That's my take. I mean, I'm just sort of looking at it from a very practical point of view. I think that's what's going to happen. This is all a lot of song and dance kind of pony show here with Trump being such a big part of the news cycle right now. We'll see what happens in a couple months.
You certainly will, but I'm with you. I think that seems like the most likely outcome at this point. All right, Pras, great stuff. Thanks. We'll keep right here on Yahoo Finance. We're going to take a deeper dive into the catalyst that's driving tech stocks lower today. Plus, Johnson & Johnson out with its quarterly results before the bell. We will hear from CFO Joe Wolk about the company's latest report. That's all coming up next hour.
It's just after 10 a.m. here in New York City. I'm Madison Mills alongside Shauna Smith. Let's dive into the catalyst moving markets today.
Well, tech stocks are falling, pushing the Nasdaq off more than 1.5% on reports of further export controls. That's leading chip stocks really to the downside here. You got ASML, Nvidia, TSM all falling on that report.
And this comes as earnings season is in full swing here. Investors paying close attention to those corporate results. So far, earnings growth is on track for a rebound up over 16% year over year. That's according to Evercore ISI. But will that be enough to sustain the current market rally amid the rotation that we're seeing? We'll discuss all of that and more.
Plus, J.D. Vance, the running mate of former President Donald Trump, is set to speak at the Republican National Convention today. This coming after Trump laid out his vision for the American economy. In a Bloomberg interview, we will dive into what a potential Republican presidency could mean both here in the U.S. and also from a foreign policy perspective. But first, let's take a quick check of the markets. You've got the S&P 500 and the Nasdaq under pressure here this morning. You've got the Dow holding on to a bit of gains, up just about 83, but the S&P off just around 1%, the Nasdaq off nearly 2% here. And Maddie, we've been talking about this all morning, the move to the downside coming on the heels of that Bloomberg report that the Biden administration is considering for a further crackdown here for chip stocks. This is all about exports here to China and ultimately the fear that we're seeing play out here in the market today, at least when it comes to some of those leading chip names, has been ultimately what this means in terms of the implications there for their businesses in the long run.
A day like today is exactly why we have consistently been talking about why you want to be wary about a degree of market concentration like what we have seen over the past year here, driven particularly by the outlier Nvidia, but also by a majority of those big tech names, driven by the AI rally in particular. I do want to go back to the big board looking at the S&P and the Nasdaq because the Nasdaq is nearing declines of 2% on the day. Obviously, a lot of hours to come before the close, but if we do get a decline of the Nasdaq of 2%, that will be the biggest decline in the Nasdaq that we have seen in over 350 days. That winning streak of the Nasdaq more broadly is the longest streak of gains since the global financial crisis. So that would be a very defining day. And right now you're seeing the Nasdaq ticking below that 2% level. So we'll see how that goes throughout the trading day here. But some positive news in the market. The risk on rotation is here. You're seeing positive movement in the Russell 2000, up over 10% here in the last 5 days. That is the biggest streak of gains for the small cap index since April of 2020. So certainly seen a lot of upside movement in the small cap sector. And Shauna and I were discussing how we're seeing the Nasdaq in particular underperforming the Russell 2000. So joining us to discuss the room that we have to run for the small caps rally here, we've got Chris Versanti, MAI Capital Management Chief Equity Strategist. Chris, thanks so much for getting in here with us.
Thanks for having me.
I really appreciate it.
Sure.
So this small cap rally, I just want to get your take on what exactly is driving it. We've been talking a lot about the cash on the sidelines, for example. Is this investors looking for a place that is accurately priced to be putting some of that money to work? What is it? What's driving it?
I think you're exactly right. I wouldn't even say accurately priced. I'd say underpriced. Boy, you have to go back more than a generation to see such a dislocation between large cap and small cap. And there's really never a certain reason why the reversal happens, but it comes, when it does come, it comes fast and furious, and we're seeing that. So for example, the Russell 2000 index, kind of the benchmark small cap index, it's had its biggest move in terms of standard deviations that we've seen in more than 30 years over the last week. So this is, now it may end next week, who knows, but I got to tell you, I've been doing this a long time and it's a very convincing reversal.
Chris, when you talk about the fact that it's a convincing reversal, I guess, so you probably think that this trade has a little bit of legs. What do you think that upside then potentially looks like as we do see this further rotation if we were to get Fed rate cuts? And I guess how critical is that part of the story for this rally that we've seen?
Sure. I don't think the Fed rate cuts are that critical. In fact, I think, Shauna, that it would scare me if the Fed cut rates. If, everybody thinks that a Fed rate cut is like you finished your workout at the gym and you're feeling good. It's not that way at all. What happens is the Fed cuts rates not to give you a break, but because because bad things are starting to happen. The economy is starting to slow. Earnings are starting to get lower. So if the Fed cuts, they're seeing something that's scaring them. So I don't want that to happen. We've done just great over the last 18 months with what we would call high rates these days. So I don't think the small cap reversal needs lower rates to continue. The great thing about it is these stocks are still cheap, even though they've jumped. And so the comparison between the large and the small right now is actually still pretty attractive.
So is it more just a valuation call, or is there a catalyst that's going to really, I guess, catapult this next leg higher there within that trade?
So you got to put your head around this weird statistic that the small caps are small. So you take 2% off of Nvidia, and it can really affect the small cap market if the assets move. The other way around, it doesn't really affect it. But the small cap is a lot of people jamming through a really small door. So this could have a lot of legs, and I don't think it's too late to initiate positions if you haven't already.
Is the Russell still undervalued, or?
Yes, no, I really do think it is. And again, value is a relative thing in this world. So would you rather own a Russell that's trading at 2 standard deviations below where it normally trades versus large cap? Or would you rather put more money into large caps that are really aberrantly overvalued compared to the rest of the market right now?
Well, is tech at a top then, in your view?
Well, look, there's terrific cash flow at places like Nvidia and Microsoft and Amazon. I'm not saying this is not the internet bubble, but the difference between the way they perform and what other cash flow producing companies have performed is really disparate. That's what I'm saying is they've been rewarded too much. These guys have been rewarded too little for producing the same amount of cash.
So those that are looking to get in on small caps, I guess, how would you advise them to gain exposure to that? Where more specifically are you seeing that opportunity within the group?
Well, there's a number of mutual funds that focus on small cap. Small cap is hard because it's relatively illiquid. They're not covered as much. So I would do that, or I would do some ETFs that cover the Russell 2000 index, which again has just been the stellar performer for July.
I want to switch gears a little bit here and get your take on how this market is pricing in November while we have you. The thesis and seemingly consensus out there is that this is a market that is pricing in a Trump presidency.
Right.
How different would the market look right now if it were pricing in a Biden presidency?
Well, you'd get your specific Trump stocks and Biden stocks that will move in the short term, like oil stocks might go up with a Trump victory. EV stocks might go up with if you think Biden's going to win. What I would warn investors, though, and so many times we've all seen this in this election, even so far, and we're not quite there yet, is the pendulum will swing far one way. So a Trump victory is being priced in. And I would be wary of that because there's a lot of twists and turns to come. So I wouldn't hop on the Trump stock train right now. The second thing I would tell your viewers is that elections are exciting. They can move the market in the short term, but over the long term, there's only 2 things about elections that really matter. One is what happens to tax policy in the new administration. Are they going to raise or lower corporate taxes? That'll affect profits, that'll affect stocks. The second, I think this is getting more and more important, is what's going to happen to the deficit, because we have an eye on the bond market, even though we're equity investors. And if those rates keep creeping higher because people stop trusting the ability of the U.S. to pay back their debt because they're running huge deficits, that's going to be a big deal, and that will be affected by the election also.
Interesting insight there. Chris Crisanti, great to have you here on set. Thanks so much for joining us.
Thank you.
We'll keep it right here on Yahoo Finance. We got much more of your market action ahead. Again, you're looking at a downward move for the S&P and the Nasdaq. You've got the Nasdaq off nearly 2%, the S&P off just over 1%. We're seeing a bit of a reversal of the trades that have been working since the start of the year. We'll track how this all plays out. Keep right here. You're watching Catalysts.
Let's get to some trending tickers here. Shares of Five Below sharply in the red this morning, down nearly 20%. This comes after the company announced that its CEO is resigning, also lowering guidance for the second quarter, citing a decline in sales, specifically among their lower income consumers. Now, if this downside movement continues, it is going to be the biggest sink since 2020, following that CEO departure and, of course, the guidance here. Moving to the downside, I just want to run through a little bit of the analyst commentary that we are getting in after this news. Morgan Stanley cutting to equal weight from overweight, saying that margins and earnings power are likely to drift even lower than where consensus is following that announcement. Also, that new management could have heightened investments to reinvigorate sales and to remedy some of the shrink that they're seeing, but that will not be enough to delay any sort of uncertainties that they're feeling about potential EPS risks to come. Just a slew of downgrades that we're seeing, right? Truist, William Blair, Jefferies is maintaining their buy, but that is certainly an outlier from some of the other analyst calls that we're getting in on this name.
Yeah, I think there's lots of apprehension exactly what ultimately this means for the consumer, further weakening, how that could pressure a name like Five Below, and then also just a CEO change. It's also sparking some uncertainty, it seems like, from the street. You mentioned that Morgan Stanley downgrade there. They did have some comments there on the CEO transition saying that does add uncertainty, possible EPS risk. Also went on, when you take a look at Truist comments here, saying that the CEO change, quote, has completely eroded his confidence here just in terms of how they see that movement here going forward. So again, the lower guidance, the fact that there is a change at the top, adding some uncertainty here to analyst calls, and as a result, we're seeing a slew of downgrades on this name. But again, a dramatic slide here for shares of Five Below. We're looking at losses of nearly 20% here in early trading. Well, shares of VF Corp moving higher today after announcing it will sell its Supreme brand to a French eyeglass and accessories maker for $1.5 billion. The company CEO saying there are, quote, limited synergies between Supreme and VF, making the sale a natural next step. And you could see the street actually agrees with what he's saying. We're looking at a pop of just about 7%. Exactly the details of this we don't have just yet. But again, in terms of what exactly this ultimately means here, they could be buying this for $1.5 billion. And I guess the street is liking the thought of a more streamlined VF Corp here going forward.
Yeah, and this comes just 2 months after there was already a little bit of teasing out that Supreme was going to be shopped around to some new buyers. VF Corp reaching this deal to sell off Supreme to the eyewear-centered company. Certainly an interesting pairing of these two
Surprising
names.
Pairing.
Surprising pairing, thank you. That is much more direct. Because, I mean, also, VF Corp and Supreme, though, that also didn't really make a ton of sense to me, given some of the trends that we've been seeing with VF Corp. This is a company I can remember a year ago talking about their company earnings being really rough, given a lot of the market share taking that we've seen from an Adidas, from some competitors in the space. I mean, you can look around. We are in NYU land. When you see people wearing Vans, not so much. They're wearing Sambas, and that is certainly a headwind for a company like VF Corp. Adidas struggling a little bit today. They were up earlier, so we are seeing a little bit of a reversal to Adidas here, but that does not kind of take back all of the positive moves that we've seen in Adidas and the strength they've been able to maintain over the past couple of years.
Yeah, I still wear Vans. I got to get on the Sambas. I do. You're shocked. I wish you guys had a close-up of Maddie's face. She's disgusted.
No,
with all you Vans wearers out there, I still wear them, and my kids too.
But I guess
you got to switch
I'm
it
learning
up.
a lot about you today, because I also learned that you're a lacrosse girl.
Yes,
so
that's true. There we go.
A lot
Insight.
about each other. All right. Well, we are going to cover a very important company that we cover constantly here at Yahoo Finance. Turning our attention to Tesla. CEO Elon Musk's endorsement of former President Donald Trump could have broader implications for the EV maker. In the recent past, Trump has been critical of EVs, but will Elon Musk's support be able to turn the tide, at least for Tesla? Joining us now on this, we've got Mark Spiegel, founder of Stanfill Capital Management. He's also a Tesla short seller. Mark, it's great to have you here on this topic. I just want to get a broad sense of what you think Elon Musk is thinking here. What is his thinking on supporting Trump when we know that Trump, if he does enter office again, is likely going to institute policies that would be a headwind for a company like Tesla?
Yeah, to put it bluntly, I think he's sacrificing Tesla's business in the hope that he can keep himself out of prison. And here's what I mean by that. Tesla itself has reported extensive DOJ investigations into Mr. Musk. The Wall Street Journal had a very big front page story last September about grand jury investigations into all kinds of things Musk has done. There were several at least fraudulent things he's done in plain sight, including, a fake video to promote their so-called full self-driving. And there was even a tweet when McCarthy, I think his name was the last Republican, chairman of the House or whatever. And he was in Musk's office, and he said something in that tweet that basically said, if only Elon's last name was Biden, he wouldn't be having so much trouble with the DOJ. So clearly he is having trouble with the DOJ. It is unquestionable that a Trump-Vance administration is terrible for Tesla from a business standpoint. And the reason is Trump has said time and time again, as recently as last month, and it's literally in the Republican platform that he personally approved, that he wants to get rid of all EV mandates, the whole Green New Deal, the so-called Inflation Reduction Act, and et cetera, et cetera. And so that means, Tesla doesn't have that much margin anymore in its cars. As a wild guess, maybe $3,000 net a car. If that $7,500 credit goes away, it's going to have to raise prices. And if it has to raise prices, it's going to sell fewer cars. Also, of course, approximately from the estimates I've read, 70% of the buyer base for electric cars are Democrats. And, it was one thing when he would say he was neutral in the race and occasionally tweet a few kind words about Trump. I mean, now he obviously outright endorsed him. He's reportedly giving a PAC for the campaign, like $45 million a month from now through the election. I can't imagine a single Democrat, or let's say very few of them, willing to buy a Tesla at this point. So he has completely alienated most of his buying base, and not just in the U.S. I mean, in Europe, I see stuff on Twitter from Europeans because, it's the same thing. That the EV buying base in Europe are mostly liberals, progressives, whatever the equivalent of Democrats are. They're not going to buy this car either. So,
yeah,
it's going to kill the business. Go ahead. I was going to say one more thing, but if you have a question, go ahead.
Yeah, Mark, let me just jump in here because one, the pushback from Democrats, I guess, how big of a risk do you see that from the business? Is it going to be an all-out ban? Just talk to me about that backlash. And then two, real quick, we've been talking to a number of analysts over the last week, asking them this exact question and having this conversation of what ultimately the implications of a Trump presidency are for Tesla. And we've gotten a number of these quotes before we had the endorsement here. But Wedbush's Dan Ives is making the case that Tesla is still best positioned, and it's actually going to, quote, widen the gap and technology lead over its rivals. And he goes on to say that they're better positioned in this unsubsidized environment compared to some of those younger EV companies. Is there any truth, do you think, to that argument?
Fine. Let me respond to Dan Ives, to Dan Ives' point. That would only be the case if car companies were still forced to sell a certain amount of EVs and consumers were still forced to buy a certain amount of EVs. Then a manufacturing edge in price that Tesla claims to have would be an advantage. However, one of the things Trump is going to do is get rid of the EV fleet mandates, which means that auto manufacturers will not be forced to sell a certain amount of electric cars to avoid penalties. And therefore, everybody will be buying fewer electric cars without the tax credit. I mean, if OEMs don't have to jam electric cars down people's throats, okay, so Tesla can have more market share, but it's going to be a shrinking market, especially if they've alienated 70% of their user base, and then their cars cost $7,500 more. So it's that many fewer buyers. It's just simple logic here, what's going on or what will be going on.
So, Mark,
I'm sorry. Let me make one more point, if I may. Sorry. A very profitable, quote unquote, business for Tesla has been selling emission credits because it's 100% gross margin business, and it sells them to other auto manufacturers who weren't selling enough electric cars. But if that mandate goes away, if Ford and GM and Stellantis don't have to sell a minimum number of electric cars, which Trump has made it clear he's removing that mandate, that business, at least in the U.S., will disappear for Tesla. And that's by far its most profitable business.
So, Mark, I just want to talk about you short selling this stock. Short sellers on Tesla have lost a total of $60 billion since the company was founded. How much money have you lost short selling Tesla?
Oh, well, it's a good question. You know, I've been short Tesla, you know, in different amounts of size for a long time, actually 10 years now. Through the end of 2022, it had actually become a very profitable short for us. Now, through 2023, because the stock bounced so much, and especially this year, or actually this month, it's again been a money-losing short for us. But I know how it'll wash out eventually. You know, I mean, you know, despite every attempt Musk makes to pretend it isn't, this is a car company, okay? It's going to earn around ballpark $2 a share this year. Its earnings are going to be ballpark cut in half from last year. It's not growing anymore. It's not an energy company. You know, 93% of its revenue is from cars. Car companies sell at from 4 to 10 times earnings. Okay, if Tesla earns $2, you can do the math, and that's why he tries to convince everybody that it's anything but a car company. But that's what it is. His autonomy will never work without LiDAR in the cars. But he's sold millions and millions of cars without it, and he's stuck there. You know, I don't need to get too far in the weeds, but let me just say he's really nowhere more advanced than anybody else in autonomy, and he can't get there without different hardware in cars. He already sold that he said had all the hardware they needed. And in fact, they don't. So he's stuck there. The robot thing is nonsense. There are all kinds of robot companies out there. There are actually companies that are making humanoid robots. And I just saw a video, I think it was BMW, is using a humanoid robot on its assembly room floor. So he's a copycat. Eventually, maybe he'll make a robot. Eventually, maybe he'll make an autonomous car. He's going to be part, you know, a small part of a very big market. It's just going to be like electric cars. You know, he's not going to dominate any market, I promise you.
All right, Mark. Well, hopefully we can get you back on and we can ask you a couple more questions next time. Really appreciate you joining us.
Thank you. Good meeting you guys.
That was Mark Spiegel. He is the founder of Stanfield Capital Management. Coming up here, Yahoo Finance Health reporter Anjali Khemlani talks to J&J's CFO about their latest quarterly results. That's coming up next right here on Catalysts.
Welcome back to Yahoo Finance. I'm your senior health reporter, Anjali Kimlani. Shares of Johnson & Johnson rising after beating analyst expectations in its second quarter. The company also lowered its full-year guidance, citing impact from recent acquisitions. Joining me now for a deeper dive into this report is Joe Walks, Johnson & Johnson's CFO and Executive Vice President. Joe, thank you so much for joining us today. And you kind of reversed the stock there after the call. What did you whisper to investors that made them change their mind?
Well, nice to see you again, Anjali. It's been quite a while since we've had the chance to discuss our business, which I'm certainly proud to do on the results of the second quarter. We didn't whisper anything that we didn't say in our press release, quite frankly. I think investors have seen the strength of Johnson & Johnson, the diversity of our portfolio. We were real pleased with the top-line growth of better than 7% across the business. Pharmaceuticals almost growing 9% with really outperformance in 11 of our 13 key brands. Products, about 10 products overall growing better than 10%. We would have hoped that MedTech was a little bit stronger, but we've got great growth acceleration plans in the back half of this year, which should complement the business going forward. And we had strong free cash flow. As well as the results are for the quarter, as you know, Anjali, we manage for years, not quarters. And I couldn't be more proud of what the R&D teams have really established with respect to data readouts to fortify not just the balance of this year, but really the balance of this decade with respect to new products, new indications coming online that will not only help patients, but certainly lead to much better business results.
Yeah, I want to talk about that MedTech because I know that was one of the focuses on the call. You've seen with the acquisition of Shockwave and the anticipated boost it's going to give that sector. I noticed that over the quarters, and I look back as far as about 10 years, MedTech has kind of been flat over the years. It hasn't necessarily been a growth driver for the company, but it's been stable. There are a lot of things that influence that: volatility from surgery volume, headwinds when it comes to production, and when it comes to as well reimbursement. All of these things play a role. Inflation, I know you mentioned, was the other thing that you're running into. So talk to me about that and sort of what you really anticipate as this growth. What are you teasing here?
Yeah, so with respect to that chart, there's probably a lot of moving parts. If you think about 7 to 8 years ago under Alex Gorsky's leadership, we really grew by pruning. So we got rid of businesses that weren't a strategic fit or were a drain on growth. And since 2018, where we had only 1.5% growth, we've been able to consistently move that needle upwards about 1 point per year. Last year was almost 8%. We are looking forward. The Shockwave results really only reflect 1 month of that business. It's a nice complement to the Abiomed acquisition that we made at the end of 2022. That is a business that grew better than 15% this quarter, really elevates our presence in cardiovascular, and it's performing ahead of deal model expectations at the time. I think we're very well positioned to play in these higher growth markets. We were disappointed with the quarter, but we're still very enthusiastic about the business. You may recall, Anjali, at our enterprise business review in December, we conveyed to the investment community that we intend to grow 5 to 7% between the periods of 2022 to 2027. We still think we're on track. We came into the year thinking that we might be closer to 7% this year. There were some first half dynamics specifically related to contact lenses and supplier inventory levels that were bled down through the first 4 months of this year. We saw much improved performance in May and June, so very good coming out of the quarter. And then the other piece was China, where we had a 40% growth rate in the second quarter of last year. So it was a tough comp to begin with as they came out of some lockdown measures related to COVID. And we have plans in place to really improve that business with better healthcare provider interactions going forward, where some new regulations are impacting volume.
Absolutely. On the innovative medicine side, I know you're looking forward to the impact from Stelara, for example, the biosimilars coming up in Europe. In addition, you also have the different movement that you have in this sector with the investment you've made in R&D as well. So that's an area of strength. You're also pulling away from the COVID vaccine sales. So a lot of little moving parts there. Talk to me about that and what you anticipate for the second half of the year.
Yeah, so if you look at our innovative medicine business, and it's really a complement to what they've been able to achieve in terms of strengthening the R&D stable, if you will. I just look at the back half of this year. We plan to launch Tremfya for new indications in IBD, so ulcerative colitis and Crohn's disease. There are folks that are, I'd say, concerned or interested in what the Stelara erosion curve may look like. We have many assets in place to cover that, and Tremfya is going to be a big piece of that solution. We'll also plan to launch and get approval for Rybrevant in lung cancer the second half of this year. That's an area that we think we can have a profound impact. We have some really solid data with respect to overall survival and another offering for patients going forward. And Angela, I go back to 2018 when people had similar concerns about our loss of exclusivity on Remicade. It was the first biologic to face biosimilar competition. We held up much better than people anticipated. I think the biosimilar market has evolved a little bit, but at that time we had maybe 2 products in our pipeline or in our portfolio that were going to be $5 billion peak year sales. As we shared at our enterprise business review in December, we now have at least 10 products or platforms that will be $5 billion in peak year sales over the coming near term. So we feel very good about how we've been able to fortify that. Again, it speaks to really the breadth of Johnson & Johnson having 25, soon to be 26, $1 billion platforms, many of them growing either above consensus or double digits.
Yeah, I know you mentioned Shockwave is going to add to that too. When I think about the second half of the year, there's sort of 3 big things that come to mind, especially in light of the fact that you lowered guidance. One being the settlements both for talc and mesothelioma, as well as inflation, as well as this biosimilar competition, as well as the IRA. So, sorry, 4 of those things. Am I missing anything in there? Anything that we should be paying attention to that could contribute?
No, those are, I would say, the things that we think about, that we've planned for. We've been planning for years, certainly with the Stelara biosimilar coming on board. The IRA, I would say, it's really a compliment to our innovative medicine team, how they've been able to really attain stellar results, industry-leading results on the premise of innovation, elevating the standard of care with new therapies that are meaningful for patients. We've had year-to-date price decline in that business of about 3%. That's not uncommon. We've experienced that each of the last 6 years of 4 to 3% of erosion annually. And so continuing to come up with new innovative medicines that raise the standard of care is really what is the formula for our success. And so whether it's IRA or Part D redesign, things of that nature, we certainly can digest those because of the investments we make all along in R&D.
Well, as always, we'll be watching. Thank you so much. Joe Wolk, Johnson & Johnson Chief Financial Officer.
Thank you, Angelique.
Well, don't go anywhere. We've got much more on Yahoo Finance on the other side of the break. You're watching Catalysts.
former President Trump's selection of J.D. Vance as his running mate, raising questions about U.S. funding for the war on Ukraine. The freshman Ohio senator among the harshest critics of American support of that war, writing in an April New York Times op-ed that he remains opposed to more funding. So what political and economic consequences could this hold moving forward? Joining us now to discuss the implications of this November's election on the future of this war, we have former U.S. Ambassador to Ukraine, William Taylor. Ambassador Taylor, it's amazing to have you on. Thank you so much for joining us. So just help our audience, primarily rooted here in the States, understand if funding were to be pulled from Ukraine. Obviously, there's a moral question here, but what could the economic impact be for Americans listening to this conversation?
So it is very clear that U.S. support for Ukraine is allowing it to defend itself and indeed to defend Europe and defend us from the Russians. The Russians have invaded Ukraine. The Ukrainians are trying to hold back the Russians, push them back out of their country. What we're doing is supporting the Ukrainians as they do that. And that is that's been a major effort. And there's no doubt it's been costly, it's been expensive. It's been probably 5% of our defense budget. 5% of our defense budget is what we're providing to the Ukrainians in terms of the military support. So there is a cost to this, but for 5% of the defense budget, the Ukrainians are holding back one of our two major enemies.
Talk to us a little bit more, Ambassador, about the economic implications of this, just given the fact how critical this is from a foreign policy perspective. If we do see any sort of fallout, if we do see a shift in the administration come November, just how the risk that might impose here when it comes to foreign relations and specifically the relationship with Ukraine and then also with Russia.
Well, if we, as I say, we need to support, in my view, we need to support Ukraine as they hold off the Russians. Economically, that means that we are going to benefit from a more stable world community, a world security environment, if the Russians can be prohibited, defended against, pushed back out of Ukraine. The Russians are now trying to upend the order. They're trying to upend the security, the international order that gives us the ability to invest, that gives us the ability to grow. The Russians are trying to disbase that, to change that, to make that a very different order in which big countries can invade small countries. So it's important for our development, our growth, our security that the Ukrainians win and the Russians lose.
I want to talk more specifically about the potential impact of the 2024 election. The market is certainly pricing in a win for former President Trump. Obviously, you have had your own interfacing and relationship with the former president. What do you think is the potential biggest risk from your perspective if Trump does enter office again come November?
Well, I think it's hard to say. You've already indicated what the vice presidential designee, J.D. Vance, has to say about Ukraine. He's opposed the assistance, but the Speaker of the House, Mike Johnson, got the at least implicit support of former President Trump to pass that $61 billion defense bill, support bill. For Ukraine. So the majority of Republicans in the House and the Senate, the bipartisan majority in the House and the Senate, both Republicans and Democrats, the strong support of the American people. So there is that support going forward, and we'll have to see what the new administration, if there is a new administration, would put forward. We don't know the outcome yet, of course, and we're not really sure what the new policy would be if there were to be a change in Washington.
And also top of mind for officials down in Washington, companies at large, is the rising cybersecurity risk and ultimately what that means, not only from a government perspective, but what it means for private companies. And the list goes on. I'm curious what we've learned or the lessons that we've learned from the Russia-Ukraine war and maybe what that signals in terms of the need to strengthen our fighter ability to contain some of that cybersecurity risk going forward.
Well, it is very interesting that there have been small attacks, small cyber attacks, more of Russians against Ukrainians. But the Russians apparently recognize that any cyber attack on the West, and particularly the United States, would result in a devastating response. So we haven't seen that. Now, what that says is we need to maintain those defenses. We need to be able to take the offensive if the Russians were to make a mistake and launch a cyber attack against us. They need to know that they will pay a bigger price. We need to be able to deter the Russians from doing any of that kind of action.
All right, Ambassador William Taylor, former U.S. Ambassador to Ukraine, thank you so much for taking the time to join us here this morning.
Thank you very much for having me.
Well, coming up, more from Yahoo Finance's Media Week. How far could media consolidation go, and is it really going to change the media landscape? We've got much more of that ahead. We'll be right back.
This week, Yahoo Finance is taking a deep dive into the media industry as part of our Yahoo Finance's Media Streaming and Investing What's Next. Today, we're focused on mergers and acquisitions. Paramount's plans to merge with Skydance Media left investors wondering if more deal-making could be on the horizon for the broader industry. Yahoo Finance's market domination host Josh Lipton joins us here with more. Josh, an absolute honor to have you here.
That's so kind of you, Maddie. Thank you. I spoke to analysts who cover the media sector. Their bottom line, investors should not expect to see a lot of deal making in this sector. Jamie Lumley from Third Bridge says, yes, consolidation does make sense in theory, of course. After all, media companies have traditional TV businesses that are under pressure, and the rate of decline has been faster than many anticipated. At the same time, their streaming businesses are not as profitable as many might have hoped for. So it's easy to see why some see consolidation as the financial and strategic answer. But he says, there are challenges. One, there are regulatory concerns. There are regulations about who can own what, most basically. And the Biden administration, Lumley says, has not been all that friendly to deal making generally. Could a change in the White House impact that with Trump as president? Well, Lumley says that could perhaps grease the wheels a bit, but it doesn't address the bigger structural issue for these media and entertainment companies, meaning creating profitable direct-to-consumer businesses that can offset the financial losses from traditional TV. There is no silver bullet through M&A, he believes, that fixes that, at least for the big players. Another headwind to potential deal-making, according to Lumley, many media companies that might consider M&A are not in the financial shape to do so right now. They're burdened with low valuations and high debt loads. I also spoke with Doug Kreutz over at TD Cowen, and he agrees with Lumley's analysis. He does not think M&A is going to be a big prominent theme in the media space, but he does believe we could see another important trend play out, more bundling of existing streaming services. Right now, there's overproduction of content, he says, and companies are spending a lot on marketing. Bundling could address those issues, Doug argues, and it would be better for the consumer too, he says, because increasingly people simply want to purchase a reasonably priced bundle with an entertaining experience. Guys, back to you.
Great reporting there, Josh. Thanks so much. Let's continue this conversation because with more media giants dealing with unprofitable streaming arms, fewer consumers may be willing to shell out some money for paid TV bundles. Investors are left wondering if more consolidation is still in the cards. Warner Brothers Discovery CEO David Zaslav telling reporters at the Sun Valley Conference, quote, over the next year or two, you're going to see some real consolidation, whether that happens with companies buying each other or going after streaming together. For more on the landscape for the media industry, we want to bring in Rich Greenfield. He's Lightshed Partners partner and media and technology analyst. Rich, it's great to have you back. So let's start there with consolidation. My question to you, is consolidation necessarily the answer here for companies that are struggling, and why or why not?
Well, look, I think everyone talks about consolidation because they are struggling to really have their streaming apps be used. The amount of usage of applications like Peacock or Paramount Plus or even Max pales in comparison to what is happening at Netflix, let alone YouTube. Those are the industry leaders. In fact, the piece we put out yesterday, Netflix and YouTube represent 45%, over 45% of all time spent streaming on a television. That's just, two players dominating. No one ever dominated linear TV the way Netflix and YouTube dominate streaming TV. And that's a huge problem. And consolidation helps a little bit, but the reality is these companies need to invest in a tremendously larger amount of content and drive people through technology, algorithms, really invest heavily to get people to spend more time. Because right now, the big problem they're facing, people just don't watch these things a whole heck of a lot.
It's interesting since you bring up YouTube, I'm going to go in on this because there's this regulation question and question about whether or not consolidation is going to be tough given regulation. But then you've got this giant streamer of YouTube, which is obviously connected to Alphabet. To what extent do you think YouTube is at a particular risk given that?
Well, look, we made a prediction that no major M&A would happen this year, and I think that's what's played out. I think any form of consolidation will likely wait until next year until we see what happens from a regulatory standpoint. Obviously, a change in administration. I know there's lots of views on whether J.D. Vance is a Lena Khan fan or not, but leave that aside. In general, the Republican Party should be more pro-consolidation, maybe not so much pro-tech. We'll see. Obviously, former President Trump has certainly made some pretty aggressive comments about his feelings on Facebook and Zuckerbucks. But, the reality is, I do think you're going to see forms of consolidation. Maybe big media companies can't merge, but could TV stations, like transactions, you're going to see I think a much, much more intense M&A season if Republicans take control of the White House, let alone significant parts of Congress. These companies need it. Linear TV is dying. Consolidation won't fix the problems, but they'll certainly create more cost savings and slow the bleeding that is happening and accelerating as we speak. On YouTube specifically, look, YouTube is getting stronger and stronger, and there's lots of government investigations, obviously, from an antitrust standpoint. We'll see if those continue under a new administration. But, YouTube is the juggernaut. YouTube is getting stronger and stronger. The fact that YouTube is 25% of all time spent streaming should scare every media executive and media investor that's watching this.
Rich, let's talk about some of those critical deals as these companies are trying to do all they can to get more eyeballs on their screens. And we got to talk about Warner Brothers Discovery, the NBA rights, where exactly that stands. It looks like maybe TNT Network could be out. My question to you is, how detrimental is that to Warner Brothers' business? How dire is it for the company's bottom line? And do you think there's any chance that they come back here to the NBA with a better offer?
I don't, look, maybe the NBA will ultimately pay them to go away so they don't sue. But I don't believe that Warner Brothers really wants to spend $1.8+ billion on a rights package for a much smaller package with less playoff games than they have now. I think the reality is, look, there's a pretty vicious debate among investors. Is losing the NBA catastrophic for WBD because they're at risk of getting dropped by distributors, whether it's a YouTube TV or a Comcast? Will this sort of be the end of carriage for this company, or at least a significant haircut to carriage? Or is saving $1 billion+ a year, they currently spend about $1.3 billion on the NBA, is saving that money and redeploying it into other places actually going to be a positive financial transaction? There's a pretty vicious debate. I think time will tell. It'll really depend on what other rights the WBD team is able to acquire. You've seen them do some small deals like college football playoffs. Nothing terribly meaningful so far, but there are rights like UFC coming available. There are other things coming available over the next few years. It'll be interesting to see how aggressive they are if they do, in fact, as we believe, stand down from the NBA.
Okay, forgive me for this question. I live in a household with an NBA fan, but I'm not personally staying up to watch the games. Is the lack of clarity around where exactly you can find these games a headwind now that kind of dilutes the value, or is that a personal problem for me?
I guess from your personal problem standpoint, the NFL is in many different places. The NFL has been a master of slicing and dicing. There's games, obviously now on Amazon and NBC and Fox and CBS and YouTube TV, or YouTube has Sunday Ticket. I mean, there's the NFL app has mobile games. Like, there's a lot of different places for NFL content, and yet the consumer seems pretty adept at navigating that. I don't think having three primary partners, we're talking about having, NBC having games, Amazon and ESPN keeping games. I don't think that's too confusing. I have to give consumers credit. They're pretty good at finding content on these digital platforms. I think the NBA, and I think Adam Silver deserves a lot of credit for, despite the challenges facing the media space, the way you started off this discussion, despite all of those challenges, getting a pretty dramatic increase in the fees being paid for licensing the NBA content. Adam Silver probably becomes one of the stars of 2024 in figuring out how to navigate a very challenging landscape successfully.
Rich, while we have you, we're going to hear from Netflix here. My question to you is, as we get into earnings season for these media companies, what are you expecting to hear from Netflix? What's the biggest question going into that report? And do you think we could extrapolate anything from Netflix in terms of the overall health of the sector? Or is Netflix really by far just the massive leader in this space and they don't need to be too worried about the competition at this point?
Well, when you saw Netflix in Cannes at the Cannes Lion Festival with their, big setup on the rooftop of a hotel overlooking all of the Quasset, it's hard not to think that, the new giant entering the space of advertising is Netflix. And so I think every investor is going to be interested in what is happening at Netflix on the advertising front. How fast is it growing? They're investing far more aggressively in their own ad technology now. And so I think that's going to be what probably, and is that generating more, accelerating ARPU as you move throughout the year? I think that's going to be a big focus. I mean, overall, Netflix should be in a very strong position heading into the back half of the year. If you just think about it, all of these legacy media companies pulling back, cutting cost, cutting programming, reducing their marketing spend. They're all so desperate to show Wall Street profitability that they've sort of given up on trying to win the streaming wars. They're basically ceding the fact that Netflix has won, and that puts Netflix in a very strong, enviable position, especially as they're out there with a product. The ad-supported Netflix is cheaper than all of these other services. That's a pretty impressive place to be right now for Netflix.
All right, Rich, we're going to have to leave it there, but really appreciate you joining us. Thank you so much. That was Rich Greenfield, Lightshed Partners, Partner Media and Technology Analyst. Well, coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Ali Canal is in for Brad Smith today, so stay tuned for more. You're watching Catalysts. Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to know to grow your money. On today's show, positioning your portfolio ahead of a possible short-term market correction. We'll bring you tips for what to do in the second half of the year. And the AI boom. It's alive and well, so we're going to review the top AI skills you should learn to benefit your career. Plus, where do you get your financial advice? We'll dive into a report that reveals the 6 key trends within the financial advisory space. But first, the S&P 500 and Nasdaq are sinking this morning as big tech names like Nvidia, usually a leader, fall. Meanwhile, smaller stocks are seeing a rebound, up over 10% in the last week. Joining me now is Adil Zaman, Wall Street Alliance Group partner. Adil, thank you so much for coming on the show today. It looks like quite a different story for markets with the big pullback that we're seeing in mega tech stocks. We're about to enter a volatile time with the election upcoming. So how do you recommend investors should be positioning their portfolios?
I think, investors need to be cautious here because the market has gone up so much in such a short period of time. So a correction, in our opinion, is definitely on the cards. And we feel that at this point in time, investors should have some firepower to be able to take advantage of a pullback. And, we've been calling this for a long time. People need to book some profits in the big tech and spread the love into other areas of the market that could potentially benefit from rate cuts.
So you think a correction is coming. One, when do you think that correction could be seen in the market, and how can investors protect themselves now ahead of that correction?
Well, I think that it's very difficult to time the correction, right? But there are a few things that investors could do. Like if we're just talking about overall financial planning, have some firepower. In case there's a pullback, put it to work. So for example, if you have a moderate investment objective, you go 70% in equities, 30% in fixed income, market falls, you go 80-20. You increase your equity exposure. This way you could potentially get better risk-adjusted returns.
There's been a lot of talk about if and when the Fed will cut interest rates. It seems like we are going to get an interest rate cut at some point this year. Do you think if we do, that could potentially delay any type of correction? Or do you think the stock market is just so hot right now that a correction is unavoidable at this point?
I think the stock market has a lot going for it, right? Unemployment is low, inflation is low, economy is doing well. Fed, whether now or whether later, they're going to cut rates. So we are firm believers that long-term the market is going to go higher. It's very difficult to precisely time exactly when that pullback is going to happen, but as long as investors have firepower, they could use that as an opportunity. And also, we feel that with the rate cuts that you mentioned, the breadth in the market is going to improve. So investors should start looking at allocating into other areas of the market, not just focused on 4 or 5 companies in a concentrated way.
So let's talk about those other areas of the market. As we see this broadening out, we know we have this rally in small caps. Are there other areas that you think are undervalued at this point?
For sure. The bank earnings came out. We liked what we saw, right, generally. And although there's going to be net interest income compression, we feel that because of rate cuts, investment banking activity will pick up, asset management fee goes up, trading fee goes up. So we like that space. We also feel, we've been talking about this for a long time, but we feel that because of artificial intelligence, it consumes a huge amount of electricity. And because of that, utilities could do well, potentially, which was the worst performing sector last year, but this year has started to pick up. So these are the type of areas that we would gravitate towards to create more diversification in the event of a correction. Diversification would protect your portfolio.
Mm-hmm. You mentioned the bank earnings, usually the signal of the start of earnings season. We have Netflix tomorrow, one of the first big tech players reporting. How do you think these Mag 7 names, like an Nvidia, for example, will perform this earnings season? Do you think it can sustain the recent run-up that we've seen?
So we feel that these companies should be a core position in the portfolio, no doubt about that, right? And potentially their earnings will be good as well, but it's all about expectations. So again, in the short term, for the retail investor, very difficult to predict. But the problem right now is that a lot of people, the concentration risk in the market, 20%, more than 20% of the S&P 500 is in 3 stocks. And people don't want to sell these stocks. They want to hold on to them forever. Book some profits, no individual stock should be more than 5% of the portfolio, and invest in other areas of the market to protect yourselves.
Mm-hmm. Let's talk about a controversial Mag 7 stock, that's Tesla. You actually own Tesla stock. We've seen this massive rally, but it's clearly a volatile name. There seems to be some optimism, though, over robo-taxis, AI automation. Where do you see Tesla going in the long term?
I think we like Tesla. We have it in clients' portfolios, and we think in the long term it's going to do well. But it is a volatile stock, so you should limit your exposure and be exposed to it in a very diversified way. But we think there's a lot of exciting things in the future for Tesla, including the robo-taxi that you mentioned. So it is a core position in our portfolio.
Diversification, always key. Adil Zaman, thank you so much for joining us today. Appreciate it.
Thank you.
Tesla shares, as we were just talking about, they're moving lower today right now. Investors are watching closely after CEO Elon Musk announced his support for former President Donald Trump's presidential campaign. The Wall Street Journal reporting that Musk will donate about $45 million a month to a super PAC backing the former president. But what would a Trump presidency look like for EV makers and EV buyers? Our very own Akiko Fujita has more. So this is interesting, right? Because it seems like Elon Musk fully supporting Trump, but Trump has historically been very pro-oil. So what does this mean for the future of EVs?
Yeah, that's certainly a critical question, Ali, that's being assessed right now. Whether Musk's public endorsement of Trump will be a positive or negative for Tesla. Sales of electric vehicles have gotten a significant bump under President Biden, largely by the tax credits included in the Inflation Reduction Act. And worth noting what those credits are. It is up to $7,500 for a new vehicle and $4,000 for used EVs. And that has made EVs much more affordable for many Americans. There are strings attached. We've talked about this before to getting these credits. That means where a car is manufactured, where its parts and components are sourced. But Tesla's Model X, Y, and 3 have all qualified until now. Now, former President Trump has publicly expressed skepticism of the need for EVs, but his vice presidential pick, Ohio Senator J.D. Vance, is taking that a step further. He's pushing a bill called the Drive American Act, which aims to eliminate EV subsidies and replace them with tax credits to promote gas-powered vehicles. That could create a significant headwind to EV adoption and Tesla vehicle sales at a time when we are starting to see that adoption slow down. EVs accounted for less than 10% of all new vehicle sales, according to data from Kelley Blue Book. And Tesla's market share of all EVs dipped below 50% for the first time in Q2. Musk, for his part, has said he doesn't need the subsidies. He reiterated that this week on his platform X, saying, take away the subsidies, it will only help Tesla. Also remove subsidies from all industries. But our very own Ben Werschel, by the way, pointing out in his article about how significantly Tesla's actually benefited from government subsidies. The website Subsidy Tracker estimates Tesla has received 109 government awards since 2007, totaling roughly $3 billion. So, Ali, Tesla or Elon Musk can say that he doesn't want the subsidies, but that's helped Tesla along the way.
Mm-hmm. But mixed reaction, though, on Wall Street, right, Akiko? What are you hearing from analysts and investors about Musk's support of former President Trump?
Yeah, Wall Street's certainly divided, at least in this initial reaction to the impact another Trump presidency is likely to have on Tesla. You've got Wedbush's Dan Ives, who argues that a Trump presidency will be bad for EVs, but Tesla, he says, would be exempt from any of those headwinds because of Musk's cozy relationship with Trump, saying that the rewards outweigh the risk for Musk. Betting on Trump losing the IRA benefits for the industry will be negative for the EV industry, but give Tesla a scale and piecing advantage. Bearish for the sector, bullish for Musk and Tesla. Now, on the other side, you've got Ross Gerber from Gerber Kawasaki saying he doesn't buy that argument, saying that if you take $7,500 out of the price of a Tesla, it's going to be detrimental for sure. And he says, look, it has been delicate pricing for Tesla when they're adjusting prices by $1,000 here and there to boost demand. So this is not going to be good, at least in his initial assessment. Then you've got Guggenheim's Ron Yeskoff echoing that sentiment, saying that tax credit has been a key affordability enabler for Tesla. He also raised concerns about a 60% tariff Trump has proposed on all Chinese imports and the impact that's likely to have on the price of a Tesla car, given that Tesla sources Chinese batteries for some of its cars. Overall, though, Ali, worth noting that it's not necessarily that Wall Street has dampened its sentiment on Tesla. You look at where the price target is right now. Street high is still at $310 a share from Morgan Stanley. And as you noted in that earlier discussion, there's still a lot of drivers here, including the robo-taxi, expected to be a significant driver for the stock that has now been delayed, at least the launch, until the fall.
Yeah, I'm sure we're going to continue to see changes leading up to the election. Akiko Fujita, thank you so much. Coming up, the latest trends in the housing sector. We discuss fresh construction data and what it says about the housing market. That's next on Wealth.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
The latest housing construction data released this morning showing a 3% increase in housing starts in June due to a surge in multifamily construction. However, single-family starts hit an 8-month low. That's according to data from the Census Bureau. This begs the question, when will we see the single-family housing market bounce back? For more, we welcome in Rick Paliosos. He's from John Burns Research Consulting, Director of Research. Rick, thank you so much for joining us. First, I want to get your reaction to the data that we just received. What does this say about where we're at currently in the housing market recovery? Because clearly single family homes are still struggling.
Yeah, so first, thanks for having me. We try not to make too much out of just 1 month's data point, but I think the multifamily apartment surprise was nice to see. The point I make on don't making too much out of just 1 month, I mean, multifamily housing starts are still down noticeably. They're down about 23% year over year. And we expect that to continue. I will say, I think from the survey work we do in the apartment space, as well as from the conversations we have with our clients, that peak bearishness around apartments is probably behind us, which is nice to see. And then obviously if the Fed can move rates lower, that will help. On the single family side, the year has really been for home builders a story of haves versus have-nots. And the point that I make there is really in regards to the big publicly traded home builders, which are about 50% of the market. You've got the biggest one reporting tomorrow, D.R. Horton, versus the private builders. And the point there is that the public builders are continuing to grow in this environment, but they're only half the market. The smaller private builders are probably actually shrinking, losing market share, having a tough time growing in this environment. with 7% mortgage rates roughly. And I think that leads to a pretty flattish backdrop for single family housing starts.
So you mentioned mortgage rates. Obviously, those high mortgage rates really hampering this market. The Fed is expected to cut at some point this year, but do you think that's going to be enough to revive this activity?
Oh, I think it will definitely help. I think it'll definitely help on the multifamily side. The storyline, I think, coming into the year was survive until 25. I think that was Barry Sternlicht with Starwood, and a lot of groups are going to survive. And then hopefully we get to the end of this and rates start to come in maybe this year, possibly into 2025. That will help. On the single family housing side, I think it will absolutely help. I mean, the advantage that the big public builders I mentioned to or alluded to earlier is that large amount of those can buy down mortgage rates. So market mortgage rates are hovering around 7%. I know they've come down a little bit, but you have a lot of big home builders, the D.R. Hortons, Lennars, really all the public builders for the most part, that they're buying down mortgage rates to 5.5%, under 6%. In certain instances, in certain markets that are pretty soft, they're buying those mortgage rates down for the duration of the loan to about 4.5%. So that's a huge, huge advantage that, again, only the public builders can really do. So that's where I think market mortgage rates do need to come in towards the 6 handle. And when we've seen that historically, there has been a definite pickup in demand, and that will help the overall space, private builders as well.
So here's my question, though, because we still have inventory at very low levels, about 30% lower than pre-pandemic times. So let's say mortgage rates are cut, great. We are still going to deal with these low inventory levels. So isn't that going to keep prices elevated? How can we see any relief on the pricing side?
Yeah, so the inventory story has changed considerably this year. And so if you go around local markets throughout the country, Florida, Texas in particular, but we're starting to see this across most of the Sun Belt, resale inventory is up measurably. It's not only up year over year, which is easy because the year over year comp is super easy. We're back to pre-COVID norms in a lot of those markets. And so these are places where, on going back to single family housing starts, these are places where home builders have been building over the last 2, 3, 4 years. And now I think from what we're seeing in conversations we're having in our survey work, they're starting to slow things down a little bit because they can finally see competition out there in the resale market. So I think that the narrative around resale inventory being non-existent has definitely changed this year. There's definitely more supply out there.
And what areas of the country are you seeing a rebound in activity? I know you just mentioned Florida, the South. Is that still the hot area, or are there any shifts there?
Well, I wouldn't call it hot. It's actually one of the softer places in terms of housing demand right now. Prices are flat to cooling, and we're finding that home builders are actually having to start cutting prices in a lot of those markets. When you go into some of the more inventory constrained places like the West Coast in particular, the Northeast up into the Midwest, those are still very, very strong housing markets. Home builders are having a lot of success there. And a big part of the story is that they're in those places, resale inventory is still pretty tight historically. So when you want to talk about kind of a scratch your head, affordability is horrible right now in many places. Southern California, where affordability is probably the worst, the strongest new home market in terms of the home builders that we talk to and what they're seeing in terms of sales and pricing strength. And a lot of that is actually foreign buyer investor activity that is really targeting these places. And then also you go up into the Bay Area, starting to recover. And I think there's a big tech story there, AI, which is just impacting so many places.
All right, Rick, we're seeing some optimism here. Thank you so much for that. I appreciate it. Rick Palacios, Jr., John Burns Research and Consulting Director of Research. Thanks so much for joining us.
Yeah, thanks for having me.
75% of professionals are already using artificial intelligence at work, and 66% of leaders said they wouldn't hire someone without AI skills. That's according to a new Microsoft report. To discuss the top AI skills you need to have a competitive edge, we have Jeff Maggioncalda, Coursera CEO. Jeff, thank you so much for joining us today. Obviously, AI, the hot button topic right now. I'm curious what types of courses you're seeing gain popularity and momentum amid this AI boom.
Yeah, we're definitely seeing a ton of interest in AI courses. We have 800 AI courses altogether, and Coursera was founded in 2012 by 2 computer scientists from Stanford who teach machine learning. So we've been doing AI for a long time, but the traditional AI, the course popularity was really among those building AI. But with generative AI, now you have courses for people using generative AI, and there's a lot more people. So we're seeing 4 enrollments per minute in generative AI courses. The top ones are from Google. It's called Google AI Essentials, IBM Generative AI for Business Leaders, and Vanderbilt called OpenAI GPTs, creating your own custom AI assistants.
So what skill sets are these courses teaching those who enroll? And what is the skill set that perhaps is most attractive to potential employers?
Yeah, I think it's a few things. Overall, pretty much anybody who thinks, anybody who makes decisions, anybody who communicates really needs to learn to know how to use generative AI. I mean, it's a great thought partner, it's a thinking tool, and it can help you refine your thinking if you use your critical thinking properly. And it helps you express your thinking, and it even can help take different sides and challenge your thinking. So everybody should be learning how to use this as a thinking tool. But specifically, what we just launched at Coursera is a whole raft of over 100 courses on generative AI for teams. Certain job roles will use generative AI differently. Software developers will use generative AI to help them write code. Marketers will use generative AI to help them write copy and marketing campaigns. We have data scientists using generative AI to summarize data sets. So these new courses are really specific for job roles that not only teach you the skills, but give you a credential from a branded source like Meta or IBM that proves that you know how to use generative AI.
And who's taking these types of classes? Is it older Americans, younger Americans, more men, more women?
Yeah, what we're seeing is it's interesting. In the US, there are more women taking courses on Coursera, but when you look at enrollments in generative AI courses, it's 70% men, 30% women. So it's definitely skewing more to men right now, which is a little bit troubling in the sense that many studies have shown that those types of jobs most likely going to be impacted by generative AI. Those dealing with language and sound and video often are held by women employees. So we see more men than women. Millennials are accounting for over 50% of the enrollments in generative AI, followed by Gen X, then followed by Gen Z and then boomers. And then in terms of geography, Texas and India, seems like everybody in Texas and India wants to learn generative AI.
Mm-hmm. And that leads me to our next question, too. I mean, what industries, what specific companies are these folks coming from? Is it all tech? And are they taking these courses because they feel like it's the only way to advance their career? Or are they, in some cases, being sent by their employers to learn this stuff?
Yeah, we have Coursera.org is obviously the version of Coursera that anybody can come to, from anywhere in the world. We also sell Coursera for Business, where businesses license Coursera to train their people. So a lot of these enrollments, most of them are coming from individuals around the world coming. And I think you're right. I mean, there's a lot of studies that show that employers are looking for generative AI skills. There was a Lightcast just posted a survey that said that the job requirements for generative AI are 20 times higher. So there are 20 times more job postings now requiring generative AI skills than a year ago. And so a lot of people are coming to say, A, I should learn the skills generally and for my job, and B, I want to get a credential on Coursera that I could put on my LinkedIn to show people I know how to do my job using generative AI.
And what's your viewpoint on the sentiment surrounding AI? Just through your conversations with clients, customers, it felt like in the beginning everyone was nervous that AI was going to take over human jobs, but now it seems to be this embrace of AI. Have you felt that shift in sentiment?
Yeah, I agree. I think right when GPT-4 came out, well, when ChatGPT came out, it was a bit of like cold water and a major shock. And people thought, oh my gosh, this is pretty powerful and it's moving quickly. And then GPT-4 came out shortly thereafter, and it was a major advance. And people thought, oh, if it keeps going at this rate, everyone's going to be out of a job. I think there's been a little bit more measured view of like, okay, it's not going to reach human intelligence, in the next 6 months. And so this is going to be a tool that people can use. People often do say, and I agree with this, that AI might not replace jobs, but people using AI to do their job more effectively will replace people who aren't. And when we see all these enrollments in places like India, there's a lot of skilled people who are now using these critical thinking tools to become more effective. And a lot of employers are looking abroad for employees who are able to use these kinds of skills, perhaps at lower cost. So I think it's important that even if the job doesn't get replaced, people learn these skills and can prove that they've learned these generative AI skills.
And it's interesting too, Jeff, because your company has been impacted by the rise of artificial intelligence that has pressured earnings in recent quarters. But how do you think the rise of the demand when it comes to these Gen AI courses will help your business and your stock moving forward?
The day that Coursera was founded back in 2012, the whole premise was bring universal access to great education so that people can not only have access to learning, but also have access to job opportunities. And the reason that people need to learn new things is because things are changing. The faster things change, the more people need to learn. And so we see generative AI not only as something that has created a lot faster rate of change and will require new skills, but it also totally redefines how people will learn and how people will teach. So we see it as a big opportunity, which is why we've really been leaning into the content piece, the learning piece, and the teaching piece as well.
You guys report earnings next week, so looking forward to that. Jeff Maggioncalda, Coursera CEO, thank you so much for joining us.
Thanks for having me.
Coming up, where can you hedge your bets amidst market uncertainty? We explore that right after the break. Stick with us.
Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line long after the presidential polls have closed.
Our bottom line, it's still the economy, people.
We've got team coverage from New York to Los Angeles, but we start right here in Washington, D.C.
You can catch Capital Gains on all your favorite podcast and streaming platforms. You can't afford to miss it.
According to a Bank of America fund manager survey, the majority of respondents see a soft landing. But BofA warned that hard landing risks are underpriced thanks to a slowing consumer, labor market, and government spending. Here to discuss safe haven ETFs to hedge your bets, we have Christy Akulian, BlackRock head of iShares Investment Strategy Americas, as part of the ETF report brought to you by Invesco QQQ. Christy, thank you so much for joining us. Obviously, we're in a time of some uncertainty, especially with the election coming up. So what are some of your go-to safe haven ETFs for investors to really protect themselves?
Yeah, and thanks for having me. It's great to be here. We just published our mid-year outlook, our iShares investment directions piece. And in it, we do talk about how we're still relatively constructive on equity markets and on risk assets more broadly. And part of that is just because growth has held up better than we expected to. So I think that, we're generally risk on, but that certainly doesn't mean that we're reaching for risky assets, right? So I think ways that we're thinking about hedging and getting smarter about some of the volatility that we expect in the second half of the year, we really prefer being up in quality. And that's very much true in equities, and something like QUAL is a fund we've been talking about a lot that's really resonated with investors. So really just picking the highest quality companies across sectors rather than taking a really specific sector bet. I think other ways to think about hedging your bets, we really like the yields that are on offer in fixed income right now, even though maybe some of the spreads are a bit tighter and valuations are a bit richer. So we specifically like income. We like something like BINC, which is the BlackRock Income ETF that's actively managed by Rick Reeder. We think that there's just a tremendous opportunity to actually capture some of these higher yields on offer and maybe diversify a little bit away from some of the technology plays, the equity plays that are pretty heavy in people's portfolios right now.
And speaking of the election, Trump currently favored to win, but we know how quickly those polls can change. Are there any areas of overlap between political parties that investors should consider? That way they're protected no matter who ends up in the Oval Office?
Yeah, and I think that's exactly the way to think about it, right? We hear a lot from investors that they're worried about the volatility that comes with elections, and they're worried about election results. I think the number one message that we have for investors is just the importance of staying invested. We just like to remind people that irrespective of who holds power, equity markets do what they do, and that's typically go up. So, I think that's one message. There are certainly some areas that we think there is some overlap in terms of both party agendas. So sort of regardless of who takes power in November, something like IETC, which is our Technology Independence Fund. This is an active fund that's actually specifically looking for companies that are benefiting and shoring up technology independence here. So benefiting from some of those onshoring trends that we've heard about. And I think that really has sort of bipartisan support right now. If you look more broadly, there's tremendous investment that's being made in things like infrastructure. We think that's going to be a huge, really important part of people's portfolios going forward. So something like IFRA, everybody needs bridges and roads, whether there is a Republican or a Democrat in office. So, really just building for the future, things like that.
And we know the ETF industry has been aggressively innovating, especially when it comes to active ETFs. Can you first explain to us what exactly this is and why we're seeing such growth?
Yeah, absolutely. And we just published a paper yesterday. It's a pretty bold call. But we do project that active ETF assets under management are going to grow to $4 trillion by 2030. So again, that's a pretty aggressive growth rate, but it's in line with what we've been seeing lately. So in terms of where that growth is coming from, I think there's a couple different categories of active investing. There's the traditional kind of stock and bond picking, the alpha seeking that you maybe, comes to mind immediately. I think there's some other really interesting cohorts of funds that are things like outcome-based investing. So some of them are yield enhancing, using option strategies and overlays and things to either buffer against a downside or actually increase income in some of those as well. So I think there's a lot of flavors of active management, and that's part of the reason why we see such growth opportunity is because there's kind of something for everybody.
Love it. Christy Akulian, BlackRock, head of iShares Investment Strategy Americas. Thank you so much for joining us and giving us your insights today.
Thanks for having me.
Coming up, inflation is cooling for many, but some retirees are still feeling the squeeze. We'll find out why next on Wealth. The latest consumer price inflation reading showed that prices are coming down considerably, especially in key areas like energy, autos, and some food categories. But some still aren't feeling much relief. According to Mary Johnson, a Social Security and Medicare policy expert, prices of things that seniors typically spend the most on remain stubbornly high. Here to tell us how that is impacting retirees is Yahoo Finance reporter Carrie Hannon. And Carrie, there are quite a few things at play here. So walk us through what's happening with these seniors and their spending.
Oh, thanks, Allie. I appreciate it. This is a big topic because, yeah, everyone's excited to see this good news that inflation has cooled a bit for the first time since 2020, but seniors just aren't catching a break. And when we look at the categories where they spend money, we are seeing them ticking up continually. And we're looking at, let's start with there's housing. Shelter costs are up, 5.4% or so. And housing takes up about 50% of a senior's budget. So this is significant. We also have seen an uptick in electricity. That's up 4.4%. And are you kidding? With the summer heat we're having right now, you can imagine what those bills are going to be like. So we've got this uptick in the electricity bills, uptick in housing, and uptick in some food categories that do impact them, like eggs, for example. But the other ones that's quite large are healthcare, which you can imagine, and that's both hospital costs, inpatient cares are up, as well as outpatient care is up, and that's around 4% for inpatient and about 7% for outpatient. But there's also an uptick in other areas of healthcare.
So, Carrie, you just listed off quite a few areas of concern. Which area is probably the most concerning for seniors at the moment?
Yeah, Alec, thank you for saying that because I meant to dig into that a bit more in the healthcare piece. Okay, this is huge. The fact is most seniors can't afford to have assisted care, living situations and so forth. And they're going to rely on this in-home healthcare. This is a huge growing area in the healthcare field. And these costs are up year to year 11.4%. So this is roughly 3 times inflation. This is something that really is going to hit seniors' pockets hard. And moving forward, we're not seeing any abatement in this area as well.
Important stuff. Carrie Hannon, thank you so much for your reporting there. Appreciate it.
Thanks, Ellie.
Speaking of high prices, we're seeing some weakness in the high-end luxury sector, and even items like luxury watches, which are normally seen as immune to fluctuations within the high-end consumer, they're having a hard time. Here with more is Yahoo Finance's Praz Romanian. And Praz, you're looking at a potential slowdown in sales for Rolex watches, right? But only in the secondary market? Maybe, maybe not?
Some interesting dynamics going on here in the Morgan Stanley Watch Chart's latest report for Q2. We've been seeing, they've been seeing for 9 quarters in a row, watch prices in that secondary used market have been coming down since these pandemic highs. People were going crazy for high-end watches. Bitcoin was booming. People were using that money to buy their fancy watches.
From Bitcoin to a Rolex.
Yeah,
Why not?
Seen it in Miami, the Miami effect, the Jersey Shore effect. I was kidding. So what's going on now is that's been happening now for a long time. But Rolex was always considered this gold standard. You can't buy Rolex at retail. You walk in right now, you can't buy a new watch. You got to buy it used, or you got to buy it in the gray market, which means it's an unauthorized new model from a different market, right? So what's happening now is that Morgan Stanley and Watch Charts are seeing that there's actually more, believe it or not, more supply coming on into the new market, the new actual retail, and that's bringing down prices in the used market and bringing down those gray market new models, and that's causing some problems for flippers, right? This is an investment report. People who are actually investing in watches, they're seeing that, wait, my Rolex that I bought in the gray market coming down a bit, that's kind of a concern to me. Right. But I think it also is unsaid in the report, and I think this is kind of big, is that potentially, maybe demand is actually coming down a bit for Rolex, which has not been the case for many years.
So I want to dig into that a little more, because is this a Rolex specific story, or is this tied to the demand slowdown that we're seeing in the luxury sector at large when you think of names like Burberry or Hugo Boss, for example? Yeah, like LVMH, all these big brands did really well in the pandemic as well. There was a desire to spend money, and why not spend it and enjoy ourselves. And then we saw that kind of come back a little bit for Burberry and a couple other brands are in a little bit of a tough spot right now. Rolex seemed to be on its own thing. It's a valued commodity. You could actually use it to trade for goods. You could buy 2 Rolexes and go a new country and start over, right? With I got $50,000 on my wrists, right? So that was considered an outlier. But now we're potentially seeing that people are hesitating at paying
$15,000 for a steel sports watch, even if it's Rolex. Maybe I don't need to do that, put the money elsewhere. So maybe there is some sort of bloom coming off the rose of Rolex.
Interesting. Well, when I decide if and when I want a Rolex, I'm going to be asking you where to buy from.
Maybe you can actually
when to
buy it. Well, now you
Maybe
can actually
I
buy
do
it.
I know. Now might be the time for me. Very exciting stuff. Praz, thank you so much, covering all things luxury for us. Coming up, a look at what the future of financial advice could be down the pike. That's right after the break. Stick with us.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
More Americans are seeking financial advice, but how they get it is changing. A new survey out today by the World Economic Forum breaks down what the future of financial advice looks like. To discuss future trends, we have Megan Andrews, World Economic Forum Capital Markets lead. Megan, thanks for joining us. First, I want to get your biggest takeaway from the report because there's a lot to digest here.
Yeah, thanks, Alexandra. Great to be here. So look, the report, really the premise of the work is, and everything we do, we really think about what are the tools, products, services that people need to improve their financial well-being. And we know that financial advice is a really important tool for people across wealth brackets. And so what we really wanted to do is understand a little bit how the industry is evolving and changing. And what our report has really set out to do is we identified 6 key trends that are really changing the landscape. First and foremost, we see changing demographics. We think about the wealth transfer, moving from baby boomers to Gen Z and millennials. With that come a lot of different preferences, values-based. We also see a lot of women and people of color holding more wealth than ever before. And these communities that have traditionally been excluded from financial markets. And so industry is needing to respond to this diverse set of clients who have diverse financial needs and goals. In addition to that, we have people living longer. Their financial goals look really different to what they used to. In addition to demographics, we also dive into some of those changes in preferences that we're seeing in the way industry is responding with evolving business models and price points. There's a lot of misconception that financial advice has to be really expensive. And actually, we're seeing a lot of changes in that. And also technology is being deployed across the industry. And we see things like generative AI really offering some real opportunities to scale and broaden access. And finally, one thing we point out is we're in an era of abundance of information. Social media is playing a really big role in that. We know people at the click of a button have access to so much financial information, and sometimes discerning what quality information and relevant to you is tricky. And we really make the point that there's a difference between financial information and financial advice, which is provided by a regulated professional, really tailored to you as an individual.
And I want to pick up on that point because we have seen a rise of influencers, I guess you could call them, which are financial influencers. But as you were just saying, there's a lot on social media. So how would you advise people to sift through the noise and really protect themselves when they're looking and seeking out that financial advice?
Yeah, look, that's a great question. And I think that's on the mind of regulators and policymakers, but should be on the mind of everyone who's consuming this content. Before I dive into the risks, I think there are some advantages too, right? I think when we think about access to this sort of information, a lot of people really haven't had access to some of this information before, and they can turn to social media and really have an authentic experience, something that's really relatable. Someone who looks like them, has the same goals, asking the same questions that they have. And so that's a really powerful conduit. And so when we think about getting people interested in financial markets, which is a good thing for them to secure their financial future, we can't ignore those benefits. But absolutely, it comes with risks. And there's disinformation, misinformation. There's, a lot of content creators also get payment for a lot of the products that they advertise. So there's a lot of incentives at play, and you have to be really cautious about what you're consuming. And I think what's critical, our data had shown with a survey that we ran that a lot of younger people, Gen Z and millennials, use social media as one of their information inputs, but critically, they don't use it as the only input. They really couple that with research from many other sources. And I think that's critical. Anything you see on social media, do your own research. And actually, what we really advocate for in our report in particular is look for a financial advice model that suits you, because that can be a powerful tool to help you make the best decision.
And you mentioned how women, people of color, they are accessing this information more, they are investing more, they want to find out the answers, and they have questions about their financial future as well. So can you quantify or put into context how much this new wave of financial advice is helping those historically underrepresented groups?
Yeah, look, we're seeing changes. And I think critically too, we're not there in terms of how good we can be in serving the diverse needs and the diverse goals of everyone. But I think that, even if you take women, for example, by 2030, they're going to hold a significant proportion of global wealth. And what we're seeing is a lot of traditional wealth managers responding to that, having particular outreach strategies to reach this group. We're also seeing a lot of new entrants in the market serving their needs. So really building up bespoke offerings that are particularly targeted at women of a certain age who are grappling with certain financial milestones. And so I think, we're going to see that more and more, and we're excited to see progress towards that. And I think that what's critical is really identifying the impact that this changing demographic is having, and that industry listens to that and begins to strategically respond.
And another standout for me is how investors want a holistic approach, but they also want it to be hyper-personalized. Do those outlets or resources exist at the moment? And if not, is that an opportunity for perhaps a new company or a new resource to come and provide that to these consumers?
Completely. I think we're seeing some innovations in that space and a lot of kind of this one-stop shop for all of your financial needs. I think that, there's this misconception as well that you go to a financial advisor for just investment advice, or you might go for some tax planning advice, or you want to save for retirement. But actually, where there is the most powerful conduit to improve your financial well-being, it's actually that holistic approach. Understanding your long-term financial goals, how that fits into how you manage money today, how you're saving, what you're saving in, what you're investing in. And actually, I think that holistic approach is really powerful. And there's research that shows that such a holistic approach can save the average household about 7.5% of their annual income just by bringing all of these pieces together, whether it's related to tax or investing or debt management.
Megan Andrews, World Economic Forum Capital Markets Lead. Really appreciate you joining us today.
Thank you, Alexandra.
All right, well, let's do a final check of the markets. We're seeing a significant pullback from those record highs with the tech-heavy Nasdaq selling off hard today, down about 2.5%. This is stemming from two main fears here, one being worries about U.S. export curves on China, and the other focused on concerns regarding Donald Trump's stance on Taiwan. That's dragging down those big chip makers, with ASML falling more than 10%, Nvidia down more than 5%. We're seeing the Dow as the only index in the green, up about 0.5%, while the benchmark S&P 500 joining the Nasdaq under some pressure today, down more than 1%. We'll see if the stocks can recover heading into the closing bell. But that's it for Wealth. I'm Alexandra Canal. Thank you so much for joining. And stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern. You won't want to miss it.